All right, we
Awesome.
are live. Kyle Seagraves from Win the House You Love. Thanks for taking the time with me to join me and talk some mortgage stuff.
Absolutely. Yeah. Thank you for having me. I appreciate it. I've
Yeah,
been
for
following
sure.
you for a while, so it's good to be here.
Cool.
And
Yeah, I've been following your channel. It's been blowing up.
I cannot believe that this is like the what? So this is the second live,
Right. Yeah, just started
right?
last Monday.
Oh man, what an honor.
Yeah, I know. Yeah, one of the first guys I thought about, just because I think, especially if it's a real estate agent or another mortgage professional, just the conversations that we have, if we just have open and honest conversations about the market and get some feedback from some people watching, that's going to be beneficial, because me and you really align with the kind of stuff that we have on our channels. We're trying to promote home ownership and help people navigate what is a difficult process. For
Right.
some,
Yeah.
it can be stressful. And, one of my main goals is just to make it simple for folks, 'cause it doesn't have to be this overwhelming, super complex thing. And so, yeah, it's more of that, right?
Absolutely. Yeah. It's unfortunately the buying process can be a little bit frustrating and overwhelming, I think, for a lot of people. And what's really cool, I think, about YouTube is maybe not just about YouTube, but like the traction from YouTube is seeing how many people really want to take ownership of what they're doing. Um, because, you know, we we both have people who are watching really boring videos. At least they seem like they can seem really, really boring. But people really want to take ownership of the process and feel like they're in control, and make sure that they're like planning a future for themselves and their family moving forward, which I think is fantastic. And so it's cool to be able to help people through that process in that way, like where they're saying, I really want to learn more about these types of loans, or how appraisals work, or what happens when this bad situation goes on, and then we kind of step in with them and collaborate through that process, to help them have a little bit more ease on the other side.
Right. Yeah, I've had some cool stories and feedback, and I'm sure you've had the same, where I talk to somebody and they're looking to get pre-approved, they're going to buy a house, and oh, who do I have to thank for referring you over? And they say, Matt, I've been watching your YouTube stuff for 6 months. And recently I had someone tell me that they were getting together with folks at the place where they work, and all three of them are planning on buying a house in the next 3 to 6 months. And on their lunch breaks, they would pick a video or two and they would watch it
Mm.
every single day. And so they were like going through this education
Yeah.
part. And you know what I thought about today as I was like running? Like, you've got people on online forums and you've got people watching, videos to make a few $100 on GameStop stock or whatever the heck they're doing, right?
Sure. Yeah.
And somebody could watch your videos and they could save tens of thousands of dollars, whether they use you or not, whether they use me or not. They could go out there and they could buy a house the right way. They could learn a few things that help them out, save them and their family tens of thousands of dollars. And, so that's as important, or maybe more than, time spent watching investing videos or watching other videos that they're watching to
Yeah.
help them and their family, their position.
Absolutely. Yeah. I just want to say really quickly, it looks like we got Zach and James here in the chat. So
A couple of
what's
your
up, guys?
fans.
What's up, boys? These are both mods on the channel, so it's good to see them here.
Okay.
Um, yeah, I'm with you though. That's what I think, where people can get super overwhelmed in the buying process is like, um, seemingly small decisions, like you mentioned, can cost thousands, tens of thousands, sometimes even like hundreds of thousands of dollars. Like I remember talking with a client who was moving from Arizona to Ohio, and you use like the debt consolidation calculators and stuff with MBS Highway, right?
For sure. Yeah.
Um, so like for those who might not know, like on the mortgage side, we have some like pretty cool calculators that help us guide clients through the process. And so I remember these clients, they had a bunch of equity in their house. Like I can't remember exactly, it was like 40 to 60 grand. And they were wanting to take all that and put it on the down payment for their home in Ohio. And so I talked to them like, hey, what if we could do that? Sure. But what if we did a minimum down payment on the home in Ohio and took the rest of the money and paid down like all of your debt? Like not just some of it. Literally, you're going to be debt free except for a mortgage, right? So you're going to have a completely positive net worth. Let's take that all away, remove all those monthly payments. And, using some of those calculators, by them making that decision, that increased their net worth by $200,000. That's a that's not even like a theoretical thing. That's like $200,000 extra in their pocket over time, because they made that decision. That's like $200,000 they can go pass on generationally, which I think is super cool. So it's like that small decision of we didn't spend any extra money. We just took the money that we had in one place and decided to push it to a different place. Now can save us literally hundreds of thousands of dollars. So I think that's cool where we can uh, be in that process with people and guiding them through, since we can see some of these numbers, and we see them all day, kind of analyzing them and being more granular with what that strategy looks like.
Right.
So
Yeah.
I think it's the cool thing.
Right. Yeah. Me and you are both plugged into MBS Highway and the certified mortgage advisor course with Barry Habib and his team. And, people forget that it's really an emotional thing and it's an exciting thing to buy a house. And the mortgage is kind of an afterthought. Like, okay, I know I need a mortgage, but I want to buy this house. People forget that just like a financial advisor advises you about your assets, a mortgage advisor is a debt advisor. And the way you structure your debt, the way that you use your debt going forward. And like you said, it might be paying off credit cards and putting less down on the house. You can really change, the trajectory or the
Yeah,
destination of you and your family's net worth by doing it properly. And I think
absolutely.
that's what that certified mortgage advisor course is all about, is that, you're the advisor and you're going to help people make decisions. It's not just, hey, I've got a 2.99 rate available or 2.75. It's based on you and your family's plans and what you're trying to do. This is how we want to set up your mortgage. We might set up something today and with a plan to refinance it 3 years from now. And when you come back to us and life has changed and the kids are out of the house or there's money needed for college or an investment property comes up, all that stuff gets factored in. Where if you have a good quality mortgage advisor who's your debt advisor, it can make a world of difference. And so that's the
Yeah.
stuff that's fun for me. Just like you had that story, Kyle, like the numbers part of it for me, always being a numbers geek. And I had my stats teacher in college telling me like, you should get into stats. And he was trying to talk me into doing
Yeah.
a master's program in stats, but he was explaining the
Did he
jobs,
hate you?
What's yeah,
Did he
well,
hate you?
he was, and that was the thing too, is he told me, he goes, hey, UC Davis has this great program on stats. And I'm asking him, like, honestly, as a college kid, what type of jobs would I be doing? And he's like, well, you could work for the Department of Transportation and you could figure out, using statistical analysis for how the trains and the traffic, and it was all this stuff where I thought to myself, that sounds like I'm in a cubicle, in front of a computer all day long, which, my favorite part about mortgage is the fact that I'm dealing with people. I'm dealing with like such a variety of situations and being able to impact people's lives. I don't know if I would feel that same joy, analyzing, a certain intersection and how we can
Sure.
maximize that.
Yeah, the impact is a little bit more different on the mortgage or the financial side. And the hard part too is like, the mortgages are just so frustrating in the home buying processes in general that like people aren't trying to spend their extra time going through it. Because I get it, like it's not fun to we kind of just want to like pull off the band-aid and get it over with. But it's when we do take some time to slow down is when we can, and if we work with somebody who like can help us navigate that a little bit more in the strategy that we're taking with how we're structuring our debt. I know it's not as exciting as like structuring our assets, but when we can structure our debt correctly, that's going to save us quite a bit of money. And although it's not fun right now, it's like, well, it's going to be nice to have a few extra thousand in my pocket because I didn't go spend that or have to pay that to somebody else through the process. But
Right. I'm
there's
gonna
some
I'm gonna pop up a
questions
couple of these
in there. Yeah.
questions. I got a familiar name here, Al Bundy.
Al
Uh,
Bundy,
yep.
hello.
Should I listen
And
to an agent
Angelica, Linda.
to pick the title company? And I can answer first, and then you can add what you want, Kyle. But in general, in real estate, if you're buying a house, the listing agent is choosing the title company. I don't know if it's different for you in the states you're in, Kyle, but in California, it's generally just the listing agent opens up escrow, and we're going to use that title company. When buyers ask me, hey, can I choose a different title company, different fees? They're all going to be, bless you, similar cost and whatnot. So it's not really going to make a huge difference. And I've seen a few contracts go out where the buyer actually, asks for a specific title company. But I'll tell you what, in this market right now, the sellers are making all the rules. So I wouldn't see that on a contract in 2021.
Yeah, most of what I'm familiar with in Ohio is it's actually normally the buyer picking the title company. And I say the buyer, but it's primarily the buyer's agent. Because Al, I know you also mentioned a follow-up question of like how does a lender look at title companies? For the most part, the title company isn't going to have a huge impact on you through the buying process. Now, there's obviously going to be some nuance there, but for the most part, title companies tend to be very similar in cost. At least they are around our market. Are they kind of familiar or same for you?
I'm sorry, what was that?
Like title companies being pretty much around the same cost. It's not like shopping title
Right.
companies are
Yeah.
going to have,
Yeah.
it's not like mortgages where you can shop and find huge savings. Title companies, you might save $100 here and there. It's nothing super crazy. The big thing that you want when you're working with a title company is somebody who's going to complete the job, get it done, and get it done quickly. That's normally the big difference with title companies is who's going to give me a title report back in 4 days versus who's going to give me a title report back in 3 weeks. Because I've seen title companies do both, and you don't want the one who's going to take 3 weeks because that it's in the mortgage world. It's like the every day that we don't have a document is one day that we could have closed earlier is at least
Right.
how I try to think
Yeah.
about it. So it's like
It's
you know
interesting for you out there in Ohio that you got the buy side because the sell side's picking the title company. So if the title company doesn't get me back fees and is lagging in any way, I send that message and I can CC the agent. And you wanted us to close in 22 days, and we're giving it our best shot, but we're waiting 3 days for title fees from the title
yeah.
company, and that's yeah.
Yeah. And it can obviously be negotiated, but yeah, for the most part, it's usually the buyer is the one who's kind of selecting it. But it normally ends up being the buyer's agent recommends it. So I'll kind of going back to the core of your question, like uh, I think it was, should I trust or should I listen to an agent? Normally your agent's going to know what title companies are good to work with.
Right. Yeah. If
And
you
it's
trust
also
your agent, then
yeah.
you don't
And
trust
keep
the
in
title
mind
person.
too, like it's illegal for them to share any sort of kickback or referrals or anything like that. So the only incentive that they have working with this title company is that they should have a history of closing well with them and closing quickly with them.
I saw something pop up I haven't seen. I've been locked to a 7-year fixed arm. Should I go for it, which has a lower interest rate, or go with 30-year higher interest rate? Please advise. My initial thing is how much of a difference, because arms in this low interest rate environment, I haven't seen the pricing be that much better.
Yeah.
And so barely any of them are getting written, because if you're looking at an arm that's got a 2.8 and you can get a 30-year fixed at 2.9, it's like, why take the risk? That's my personal opinion.
Yeah. I'm right there with you. I don't have anything extra to
Okay.
add.
I'll let,
Maybe
I'll
I
let
could
you
give
st-
some.
I'll let you start on this one. Can you go from duplex to duplex using an FHA loan?
Ooh, that's really tough. Um, the easiest way to go from if you're trying to carry both at the same time, right? If you want to do one duplex, sell it entirely, go to a new duplex with an FHA loan, that's going to be doable. If you're trying to keep that FHA loan and then get another one on a duplex, that's where an underwriter is going to start having questions because what they're trying to do is make sure that there's no hint of occupancy fraud going on with an FHA loan because it's only for a primary residence. So when we purchase one duplex and then keep the FHA loan and purchase another duplex with an FHA loan, it starts to look a little bit like occupancy fraud, like we're gaming the system to get an investment property with the FHA loan. Normally, FHA wants to see that we went from a duplex to a single family. That's what would be an upgrade, right? So that's an upgrade for a single person. If our family size changed, of course, we can go to a bigger home. But duplex to duplex is not really seen as an upgrade. And it can be difficult to get past. There have been times where I've gotten some very strange on the border scenarios passed through an underwriter, but it's going to be almost entirely up to their discretion on are they going to sign off on this being a true primary residence? Like, do they feel comfortable that your intent is primary residence? I've once had somebody who went from a single family to a VA duplex, somehow got that through.
Right. Right. Yeah. I mean,
uh,
people do stuff that, you know, if you've got a reasonable explanation to an underwriter, what, I'll back up what you're saying. There are certain rules for getting a second FHA loan. And I made a video on my channel about those exceptions where, you know, you got a family size change, you're changing for a job and it's X number of miles from the house you're living in. If you bought it with a co-borrower and the co-borrower staying and you're going, you know, things like that, that you can get that FHA exception. But to Kyle's point, you know, doing something like a duplex with 3.5% down is great as an investment. You have to live in one side. There's a rule about occupancy. If it appears to FHA like you're trying to kind of game the occupancy to add more rental properties, don't do that, because it's occupancy fraud. And the loan officer, you know, me, Kyle, or anybody on Kyle's team, we don't want to lose our license, and you don't want to be indicted on occupancy fraud. Not good for anybody.
Yeah. I see some people in here. Risa, Angelica. Hello, hello, hello.
Hello.
Did I miss somebody? Oh wait, no, I don't think so.
Oh, so
Mike,
Rob,
Mike's in here.
this one's kind of a follow up to that. Having FHA, then after years, using conventional to buy another duplex and move into it. You could, Rob, you just have to put a larger down payment when you use conventional to buy a duplex. So if you bought an FHA 3.5% down, you're like, man, I like real estate. Real estate investing is fun. I'm gonna go buy another duplex. I'm gonna use a conventional loan. You're gonna have to put a larger down payment, 25% down, which, you know, is a bigger chunk than the 3.5% you put originally on the FHA loan.
Yeah. Yeah, and the frustrating thing too is that if you refinance that FHA loan into a conventional, you have to refi it into a conventional investment property, which
Right.
means, you know, you have to have 20% equity at least in that home. If it's a single family, if it was a duplex, you're gonna have to bump that up to 25.
So this is kind of like a day in my office. Everybody's got questions on, you know, some things, and it's fun because there's always unique scenarios that everybody's in. Um, Moses Arroyo, thanks for joining us. I am in escrow. I recently sold a tool chest and tools, 4,200, cash in my account. Lender said we might not be able to use it. I have a bill of sale. This is going to differ by mortgage company. What would you say, Kyle, if something like this came into your office?
This one's so tough because I know what the guidelines say, and what the guidelines say is that you could probably get that done based off of the bare minimum standard. However, like the lender kind of gets to choose how much risk they're willing to take on. There's the bare minimum rules, and then the lender is gonna change how much rules they're gonna add on top of it. And most lenders just hate dealing with cash because what they have to do is if that loan gets audited, they have to explain why they approved that. And if anybody can poke holes in their argument, that becomes a real big issue for that lender, right? That's a potential for them losing thousands of dollars if they make a wrong decision there, and an auditor can come poke a hole in their argument. So that's why they tend to stay away from cash, because it's so hard to document, even though you have the bill of sale, even though you're following the rules. So to do that, you would need to work with a lender who is willing to only underwrite to those bare minimum standards. And those can be very difficult to find. I know one off the top of my head, but I would not recommend working with them, because usually the lenders who have that much flexibility are the ones who usually don't have a very smooth process going through it.
Right. Yeah. Yeah. In our wholesale world, it's like, yeah, they're going to accept it, but they're going to take 65 days to close. Yeah.
Right.
Good luck to you, Moses. I was going to say that I've had cars, boats, and motorcycles. I've never had tools that were able to show the bill of sale and use those funds. So yeah, it sounds like, you know, in escrow, and might be, you know, kind of going back and forth the underwriter. If you can get a gift from a family member, that might be a way to salvage the deal, because gift funds are fairly easy. You know, you just get a gift letter and send those funds to title. So
That's the point where you need to get a little bit creative, because, like, you know, if they're saying the 4,200 can't pass, I'm wondering how close you are to closing. It doesn't really say in there. If you're far away, maybe you start searching for some other lenders. Keep that in your back pocket. Like Matt mentioned, can we explore getting a gift from a family member? I know it's hard. I know it's a difficult conversation. At this point, we're just looking for creative options. Is there a retirement account you can dig into? You know, could you even get a loan from a family member? That's something that we can actually do through guidelines. It's actually easier to get passed through than documenting cash. So, like, there's these other things that you could try to do that are some more creative options if the $200 isn't going to work there.
Yeah. I mean, I feel like over the past few years, we've had endless scenarios like this where it's like, oh shoot, this was plan A and it didn't work, but what about plan B? And inevitably, it generally tends to work out. So I'm hopeful. I'm hopeful that Moses has got an aunt, and he's only 2,500 short, and she can give a gift, and he's going to close the deal, and they're going to be all good. I got a good feeling. I'm sending out good vibes in the universe for that one. James Hicks, besides the typical 15 and 30-year mortgage, are there other mortgage lengths? You like those flex terms, Kyle? You guys do any of those?
I do like a good flex term.
Yeah.
So there are other lengths, and this is going to depend. It's a lender to lender thing. 15 and 30 is usually, for some reason, the most common. 30 is one of the longest terms that you can get. Sometimes you can go to a 40 on a very, very, very like niche thing. And then 15 isn't the smallest term that you can get, but it seems to be, these popular mid grounds between one is long term and the other provides lower interest rate, maybe some more cost savings with it.
Right. Yeah.
So you do have some. Yeah, go ahead.
I was just going to say, yeah, I've created to our point earlier about being a certified mortgage advisor. You talk to people and you get their game plan, and it's like, hey, listen, I'm 50. I want to retire at 62. I want my house paid off. Okay, we'll get you a 12-year loan, and we can write those. Kyle has access to the same lenders that I do, and UWM specifically will go from 8 years to 30. You can pick 8, 9, 10, 11, 12, 19, 23, and for different reasons. And I think that one of the things I enjoy the most about the mortgage advising piece of my job is going into a conversation. A client might not know what they want, and I certainly don't because we haven't spoken yet. But through 5, 10, 15 minutes of conversation, we start to dig in and realize what the goals are and say, oh, well, based on what you told me, it sounds like this might work for you. And so to answer your question and not be too long-winded about it, you can pick your length. And, for anywhere from 8 years to 30, other lenders have, other products. All of them have the 15 and 30. Most of them have the 20s, 25, but UWM and some others will give you a flex term anywhere between 8 and 30.
Yeah. And if there's something that's like not offered, you can always pay your loan like a different term, right? If I get a 30-year loan, and I made a video about like 15 versus 30 years. I tend to always default like, let's do 30 and pay it like something else or reinvest in something other than our mortgage. And so like you could take a 30-year, put it in an amortization calculator and pay it like a 17-year if you want to, if that's what you want to change the term to. So looks like we got a super chat from Moses.
Oh, sweet. Thanks, Moses.
So, yeah, I don't know if you can see that on if StreamYard, like if you're still like up on the scroll.
Yeah, no, it shows it up there. I see the M. I saw the super chat. So thanks, Moses. Much appreciated. Steve Cadwell. Why aren't loans assumable anymore? It's a good question. What do you think, Kyle?
I mean, there are loans that are still assumable. It's going to depend on the lender, but in my mind, it's more of it's a little bit more risky. Oh, not a little bit. It's a lot more risky.
Right. Yeah.
To have an assumable product. Also, the cycle of money, it doesn't really make sense. Because you're having so much turnover is happening in the bond world. Like most loans are being packaged up into this little bundle called a mortgage-backed security, and there's so much turnover happening with these that it doesn't always make sense to keep that same loan there. Having that longer duration just change ownership. So I imagine those two things probably keep lenders from wanting to offer the assumption as much.
Right. Yeah. And I don't know how long it's been like that, because I've certainly heard, before I was even in the mortgage industry, about certain loans being assumable. It seems like the last, at least 15 years that I haven't seen much in the way of assumptions. And like you said, it's risky, especially if you don't have any qualifying criteria to just say, hey, I'm going to buy your house and assume your loan. And then the chain of ownership, like you said, who knows, it's been packaged and sold and whatnot. So, sorry, Steve, it'd be cool, 8 years from now to have a, 2.75 interest rate and rates are higher and be able to sell your house at a premium because they can assume that sweet loan you got. All the Win the House You Love mods Al Bundy.
Do we got all the mod? We have all the mods in here. I love
All the mods. Yeah, it's like a mod
it.
party. I wonder, maybe we can get some follow up to this question. How often do PMI rates change? Could it drastically change in 5 months? Um, I'm not sure if you're talking about conventional loans or FHA loans. Because conventional loans, what you're going to pay in private mortgage insurance, that's what that PMI stands for anyone wondering, um, is going to vary by lender. It's going to vary by credit score. It's going to vary by down payment, and those rates can change. I'm wondering if Zach's speaking of a scenario where he's got a loan already secured and it's changing for some reason, or if
Hmm.
it's on this note. I heard something today about FHA. There's at least a rumor that 0.85 PMI that's attached to FHA loans might get lowered.
Yeah.
That's
Was that the 3 points, Matt Ishbia?
Oh yeah, it's
Yep.
my guy Ishbia, which is funny because I actually had an internal conversation with my team about what is FHA going to do because their market share has kind of dwindled, and we could talk at length about the market and why it's tough to get something accepted FHA right now. But even before the market was as competitive as it is, and as all the reasons why it's hard to get an FHA loan accepted, there was already kind of this trend where mortgage insurance was getting cheaper on conventional loans, and conventional loans were kind of outselling um, FHA loans. They
Mhm.
just were better for a larger portion of people, because I remember 3 or 4 years ago where I looked side by side, FHA versus conventional, even at like a 700, 720 score. Some people were better off FHA. And then, I saw in your video, and I agree with the fact that, like, sub 680, you're probably going to look better at an FHA loan if you're looking at it side by side versus a 3 or 5% down conventional. So went
Yeah.
off on a large tangent there, but if you want to follow up, Zach, with what exactly you were looking for there, I'd be happy to help.
Yeah. I'm sure I'm interested in what's going to happen with the whole like privatization of like GSEs, or the potential privatization of that, and FHA's place. So like a lot of people are familiar with it. They know the phrases Fannie Mae, Freddie Mac. So these are like the government sponsored enterprises that are basically making the rules for conventional loans, or the ones who are purchasing and packaging conventional loans into mortgage-backed securities. And there's talks of them potentially going away from being government sponsored enterprises into being privatized. And what's interesting too is like FHA was initially supposed to be kind of more of a first time homebuyer program. It was supposed to make home buying more equitable. And now we're kind of at this place where it's like, yeah, there's not a huge difference sometimes between conventional and FHA, other than these very slight differences.
Right.
Um, so like conventional, I feel like the requirements have become just so much more lax. I don't know that's whether the convention like Fannie Mae, Freddie Mac have been trying to take more market share, or what that's supposed to be looking like, but um, yeah, they're not really like set in their places anymore. They're kind
No,
of
I agree. I agree.
blending.
It's interesting to watch what happens with that, because who knows? It's funny you talk about lending rules. I don't know where I saw this, but I got some hint, and you think about futuristic stuff, and you think about futuristic mortgages where people are kind of all plugged into something where your banking info, your credit history, everything is kind of just all in one place, and you have some sort of score, and credit scores are long gone by then, and it's just like, you know, you can press a button and it's thumbs up or thumbs down for a $500,000 loan for a house. Um,
Hmm.
we'll have to figure out some other way to make money if loan officers become extinct in 20 years. But I
Yeah.
got a few
Uh,
decades left, I think.
quick following up to Zach. Zach, he was referring to a conventional loan with interest rates on the rise. Could PMI also be rising, or are they not related? So they're not necessarily related to each other. Uh, Even though like mortgage interest rates are risk based, they're also based primarily on like what's being traded on the market too, where PMI isn't really factored into It's not tied into what's happening in the market necessarily. So PMI is more closely related to the actual risk of a loan defaulting. So this is maybe a bit of a stretch to make this comparison, but like it wouldn't change along with interest rates in the same way that homeowners insurance wouldn't change with interest rates. They're not really worrying about the same types of things. So PMI is more interested in like the loan actually, yeah, somebody not making payments and foreclosing, where the
Right.
interest rate is interested in that fear that that pricing is baked into the interest rate, but it's also the interest rate is paying for people through the process to actually complete the loan cycle and make sure everyone gets paid through it.
Right. Yeah. And to that point, like you said, as home prices increased and we had a super healthy housing market over the last few years, mortgage PMI has gone down. Default rates have gone down, and therefore there's less risk when someone's putting 5% down, 30-year fixed, a great looking loan. And to my point earlier about conventional kind of overtaking FHA in a bunch of ways, it's because their mortgage insurance was coming down substantially. 5% down conventional today versus 2017, it's probably 40% of what it used to be.
Yeah, yeah.
Not sure what I did, but please delete. Go into Kyle's channel. Okay. Staying
I think
focused.
he said something about a loan officer ghosted her.
Uh,
Um, oh, it's super frustrating. Yeah, I contacted a mortgage broker today and he pulled credit and went ghost. Oh, that's frustrating.
that's not good. Sorry about that. Staying focused. I guess that's a sign of somebody you don't necessarily want to work with. And I talk to people all the time that for whatever reason, they talk to somebody and then don't get a straight answer or get ghosted. At the very least, contact somebody who's just going to be straightforward with you. I talked to somebody for 5 minutes yesterday and I said, listen, this might not be the answer you want, but based on your credit score, that investment property you're trying to refinance, just leave it alone. It's just you're gonna pay a substantial amount to get a decent rate with that credit score, and it's going to be a forever break even. If anyone tells you that deal makes sense, it doesn't. And whoever they'd been talking to or working with had took them through like all this doc collection, all this stuff, and ghosted them for a week. And I said, I don't need to collect your docs to tell you at a 640 credit score, 70% loan to value investment property isn't going to have enough benefit when you're at this, low fours interest rate already.
Yeah.
So best of luck to you. Sorry about that bad experience. It's like anything else out there. There's good guys, bad guys, good gals, bad gals.
And what states are you licensed in, Matt?
Just California.
Just California? Cool.
Yeah.
So if we have some California people in here, Matt's the guy to go to. Need those
Matt
purchases,
mortgageguy.com.
refis.
Yeah, just
He's
shoot me
not
an
going to
email.
ghost you.
Yeah, I won't ghost
your new tagline.
Team will certainly. We've got standard operating procedures, and we've got like written into. I run my business like a business, and we're going to get back to you in a certain amount of time, or else there's going to be heck to pay. Looking to buy, but nothing out there. This is probably a sentiment that a lot of people can agree with, Charles. And no matter what state you're in, I don't know if you know the numbers for Ohio, but I'd be interested, Kyle, for the market I'm in, Sacramento. And granted, Redfin said that Sacramento's like the number one hottest market 2021 based on their data. Sacramento County, there's 0.4 months of current inventory. Surrounding like Sacramento and surrounding like the bundled average of all of them is like 0.8 months of inventory, something like ridiculously low. And so a lot of guys in California and gals, like Charles is saying, there's, looking to buy, but there's not much out there because when you've got 12 days worth of inventory.
At this point, you could embroider that sentence on a pillow and just keep it there. Unfortunately, it's like a sentiment that I think we might be like living with for a little bit. And it's super frustrating. And sometimes it's really helpful too when you're going through the process. Just to answer your question really quickly, I don't know the exact numbers of our market, but I know it's far less competitive than Sacramento in Little Dayton, Ohio.
But still fairly low supply and a lot of demand.
Oh yeah, still low supply. I think we're probably hovering close to like a month and a half worth of supply. We're not near the 0.4 at this point.
Right.
No one
wants to
move to Dayton that bad.
For anybody is like 6 months of inventory. So month and a half is still competitive and tough.
Yeah. And with that sentiment, Charles, like sometimes it's good to just like take a week of a break We don't have to go all in. We don't have to say, "Oh, I'm completely in the housing market," or "I just gave up," because those aren't. Sometimes we like our brain wants to live in these two dichotomies. We want to have yes or no, or in or out. Sometimes we can live in the middle and say like, you know what, I'm going to take a break for a week, just to I'm going to delete all my home buying apps, turn off my notifications, talk to my realtor and say, hey, I'll reach out to you in a week or whatever. Just take some time to have some calm, recenter, reevaluate, why do I want to purchase in the first place? Is there new things that are stirring in my mind that I can change or reevaluate about what's going on? Or maybe do I even really want to buy right now, or am I buying because it seems like everyone else is? Or maybe you're buying because it's an actual necessity. So sometimes it's really nice just to take a break that helps us recenter and make some of those decisions with a little bit of a clearer mind.
So it's a well-known fact that Kyle's voice is one of the calmest on YouTube. So whenever you're feeling stressed out about home buying,
Oh
you just
man.
hop onto YouTube, go to Win the House You Love, listen to some of Kyle's videos, and to back up your point, Kyle, having worked with hundreds of people who've bought a house, something to consider, Charles, is think about, or at least have it in your head that, it might be for a reason. The first house you offered on didn't get accepted. The second house you didn't. I've had countless stories of people that came back and was like, oh my gosh, I am so happy. I was frustrated because it took me 5 months, but this is the perfect house. I know
Yeah.
this happened for a reason. And, it's happened to me so many times that now I start to believe that, there's some other force at play, that, this house that you got after these 5 months that felt like it was a stressful or, frustrating home buying experience was all for a reason, because you landed at the house that was perfect for you, in the neighborhood you wanted, and,
Yeah.
and whatnot. So stay
Yeah.
positive.
I've seen that happen a ton too, where yeah, they end up saying like, I'm so glad those first offers didn't go through
Right.
because we
Right.
love where we're at right now. And those homes weren't on the market at that point.
Okay. Who else we got here? We got some PMI. I'm in the Chico area, Butte County. Hello, Norma.
Chico.
Linda grew up in the Bay Area, so some more California folks. Somebody backing you up saying take a calm moment. Home buying can drive you crazy. I think it
Yes.
drives the buyers crazy. For the agents out there that are trying to get offers accepted, it's frustrating for them. For the mortgage brokers too. I mean, because I've got clients that, you develop a relationship when you talk to somebody and you pre-approve them, and you're, right alongside submitting offers. I'm calling the listing agent and I'm telling them we're, got a perfect package. We're ready to go. We'll press play. We're going to close in X number of days. And so your offers don't get accepted. It's frustrating for us, but yeah, if we all take a deep breath and realize it's all going to work out, then, my wife thinks it's my fault. She said, I don't want to buy. Well, Charles, this is called marriage, and you just got to take the L because everything's your fault. I was in Arizona at a mortgage conference Thursday, Friday, Saturday, and this Filipino Uber driver, super sweet guy. I don't know how we got on the subject of marriage, but he's been married for 42 years, and he told me, he's like, I've got the secret. There's 2 words that you use with your wife, and that's the only 2 words you ever have to use, and it's yes, dear. So that's my advice, Charles. Yes, dear. That's what you tell her. Should I buy before moving? Moving back to Michigan from Hawaii. I can answer this one, because we get relocators to California. You're studying in New York and you get a job as an eye doctor out in California. The conventional guidelines say that if you have a job offer letter and it's really clear, you're going to make $140,000 per year salary and it's starting on April 1st. We can use that employment as long as it's within 90 days. There's some little caveats to it. Like I remember digging into this guideline at length, and you got to have reserves for, like, if you close 45 days before, that you've got the reserves to cover you until you close. But it's possible. I think it's probably, advised too. You want to have a little bit of stability with, knowing where you're going to work. Because you certainly have to, mortgages are your ability to repay. Your income versus the debts, and the new mortgage is part of the debt. So,
Yeah.
quick answer, Chelsea, is yes. You have anything to add?
Do you know, are you finding lenders who are allowing the job offer letters now with COVID? because any of the ones that I've tried to get passed through with offer letters in the past 6 months, I feel like everyone was not accepting the job offer at that point.
I'd have to look because from memory, I've done quite a few of those, but since kind of like the June guideline changes for COVID, I don't know. And I
Yeah.
wonder, I'm going to put down a note. I'm going to send something to my account exec at Home Point. They tend to
Yeah.
be fairly flexible.
Then the nice thing with COVID is so many people are moving remote. So if your work is remote, you can get that closed actually with no problem because you don't have to be at a physical job location. All you would need is something from HR that's saying, yeah, Chelsea works remote. This won't impact her employment. It's not going to impact her income. Um, even moving to, I think you said moving to Michigan.
Michigan.
Yeah, so as long as that's happening, and you can tell the lender like I'm gonna occupy the home within a month or two, then that should be fine. That's been working really well for I know most of our buyers around here who are relocating because so much of the work is remote. Um, so the hard part though is if it's not remote work, then we start getting into issues of can we get a job offer to be able to go through on that.
Yeah. All right, we're back to the 7-year ARM question because we asked about like what's the spread. 7 years 2.625 and 30 years three and a
Hmm.
quarter. It is a good deal. Please advise. I'll do my best, even though there's some context to this that me and Kyle don't have, so we'd have to guess. But it's like, how long do you plan on staying in the house and things like that? Because if you've got a plan to, your kids are going off to college and you're going to downsize, there's no way you're in this house for more than 7 years. And I think that's an easy decision. 2.625 on the 7 year, you're going to save a 0.5% in interest and you're good to go. The only risk, I guess, lies in if you stay in this house and 7 years from now, for whatever reason, you can't qualify for refinance, or if you did, rates are 5.5 or 6%, then you'll be in a tough spot. But when I advise on ARMs, a lot of people are risk adverse and they don't want something that can adjust, and so they're willing to pay a little bit more for the security and the knowing that the rate is fixed. If you're in a stable job and you're well qualified and you don't think you'll have problems refinancing if you need to in the future, then maybe you consider the ARM. What would your advice be on something like that, Kyle?
Yeah, I'm with you. The hard part is like I don't see rates continuing to over 7 years. And again, who can predict 7 years from now?
Yeah.
But just based on like a long historical perspective, 20 plus years, we're like at a really low point for rates because there's so many factors that are contributing there. And so in 7 years, I would put money on rates are going to be higher. Now, is that the end of the world? No, it's not the end of the world. There are going to be plenty of people buying in 7 years, even if the rate is, let's say 7 years from now, the rate's at 10%. There's going to be people buying because there were people buying when rates were 16%, right? So it's not going to be the end of the world, no matter what. My inclination is I would probably still go fixed route. But like Matt mentioned, if you have a game plan, 7 makes sense. Then then go for it.
Yeah, to play devil's advocate too, it's like, hey, listen, if you get into the 2.625 and you stay in it for 9 years, you probably save enough those first 7 that even if it adjusted a 0.5 point every 6 months for those 2 years after the 7, you'd probably still end up saving. But I think it comes down to personal preference. There are some people
Yeah.
that just would never sign a loan that's adjustable, and I agree with it. I've got a lot of people that have come to me and they've got a 3.125 adjustable that's got 5 years left on it. And they're like, Matt, if I can get a 3%, if I can get a 3.125, even if it's the same, I'm going to pay for the refinance because then I know it's fixed.
Yeah.
And
please have an exit strategy on like in year 5, not year 7.
right, yeah.
Far too often we get to we can get to the end of something and then be like, oh, yeah, I'll get around to it. I'll get around to it until I need to get around to it. And then there's something I need to work on or whatever's happening that, 7 years came and, you can still carry that loan, but we just know that rate's going to be adjusted. So those are the only things I'd be careful about. And I need to go use the bathroom. I've been drinking so much tea.
There's a lot of questions, and I've done mortgage for a few years, so I can answer these. I'm just going to pop through some questions, man. You go take your time, and let me
Awesome.
see if I know how to make myself bigger on here. Boom. Nope, that's you. All right. So we've got homeowners insurance advice, and I saw a couple things down about trust in your lender. Oh, that's a float down one. I'll get back to that float down question as soon as I answer the one about insurance. It's a good idea to rely on your lender for quotes insurance. My lender mentioned their shop for me. And your lender should know some good insurance companies, whether it's State Farm or Farmers or an insurance, broker. It's going to be relatively similar. And so get a couple quotes, and then just a company that you trust is going to, be there for you if your house burns down is who you go with. But I wouldn't sweat it too much, and I wouldn't put too much thought or worry into the homeowner's insurance. As long as it's a reputable company that's, the lender is going to make sure that your insurance covers a disaster, because they're putting out a bunch of money there in first lien position. So you'll be properly insured. The lender will insure it as long as you're getting a mortgage. So get a couple quotes and roll with it. Now I'll go back to somebody's asking about locking the rate, and then they change. So this is kind of like people that watch the stock market, right? They're like, I want to find the very bottom. I know there are a few companies out there, and I think I saw in some of my comments earlier today about float downs. I worked with a company for a little while that offered some float downs. If the market gets better, most lenders, once you lock, you're locked. And that's the thing. You protect yourself against rates going higher. But if they go lower, then you chose to lock, which is generally a good idea. What's been your experience with this, Kyle?
Yeah, I have a little secret with float downs. If a lender can afford to float down your rate, they're padding your rate.
Right.
Your rate was higher to begin with.
Right.
Like they built in extra margin so that they can take on the cost when people need to float down. So, is it nice when it's like somebody overpricing a car and then giving me a discount on it, right? Like when I go to a dealership for like a used car or whatever, and they're like, well, we'll give you $1,000 discount if you sign today. Like, you were already overpricing the car by 2,000. That's not a discount. Like it's still overpriced. So that's what I found most of the time whenever I've competed and saw loan quotes against a company who will do a float down. And that's the main reason why a buyer's looking at their quote. They'd be like, well, they'll do a float down for us. I'm like, yeah, but we're already half an interest point lower
Right.
than they are. And like, this is still floating if you want it to. So like, the market's not going to change that drastically. Well, and that was pre-COVID.
Right.
So, most of the time when I've seen companies offer things like float downs, you have these like bigger companies like, probably shouldn't say their name, but the one that like goes to the moon in a certain type of ship, like those rates tend to be a lot higher. And even if you go online to like the rates that they have, and you can see all the disclaimers that they say about the credit score and the down payment that they're
2 points of
factoring
cost.
into that.
Yeah.
Yeah, 2 points of cost. It's like, well, I guarantee Matt can have a quote for that and be probably close to maybe like 0.75% to even a percent lower than a company like that can offer, just because like Matt doesn't have anything that's being padded inside of there. So cool, they can offer a float down and maybe Matt can't.
They're basically Kohl's, and they're telling you it's a $99 sweater, and they're giving you 60% off, but I've got it for 29 from the start. So,
yeah. And I will preface that with like, I'm always open to being wrong. So if you find somebody who's willing to give you a float down, great. But let's shop it compared to some other people, just to make sure that we're actually getting a good deal. Because maybe there is a company who's like willing to take the loss on it to earn the business. But let's definitely make sure that we shop around to see like, is something that's actually gonna make sense for us financially?
Right. And for context for people, like when rates move, they're generally not going to move a lot. And in a 30-day escrow period, we saw a huge move up in these last 2 or 3 weeks. But, I haven't seen rates get a quarter better in a 15-day period in, I don't know, years. And so if you're locked in at a 2.99, a lot of these companies, one that I worked for that had a lock policy. It was like it had to be that same price at a quarter better to be able to lock down. So like rates would get better, 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 but the 2.75 versus the 299 was not the same price as the 299. It was $800 cost versus 300. You couldn't float down. So there's even caveats to the float down for the ones that offer the float down. It's probably, more of a marketing gimmick than something that, is really going to be beneficial to you. So,
Yeah.
I'd
Now,
probably,
do you guys accept Kohl's Cash for your down payment?
oh yeah, for sure.
Yeah. I have so much Kohl's Cash that's been mailed to me that I've been trying to figure out where I can spend it. So I'm
Yeah, you
glad
just,
I'm gonna enter the CA market with my crazy amount of Kohl's
yeah,
Cash.
you do Cardano coins or Bitcoin or Coles Cash, all
Oh
of it.
no, I'm on Ethereum. Come on. That that and my worthless GameStop stock. So
Yeah. Did it go down today?
um I don't know. It had a little spike here recently, didn't it?
Yeah, I haven't been really following it. I've been busy in the real world. Sorry. Sorry to all the.
Mike's gonna come out here. Mike's a GameStop supporter.
Okay. Well,
He's gonna
yeah.
get mad.
I support the diamond hands. I'm not against
No,
those folks.
it
Just
jumped up a touch. What, $4 today?
okay.
You're
Yeah.
up
I
20%
wasn't
today.
necessarily bashing it. I'm just saying I'm busy writing a bunch of mortgages, helping people with mortgages.
Yeah.
So I'm not in the Reddit forums as much as these young whippersnappers that are getting rich. Um,
Yeah, today's been oh wait, no. I'm looking at the wrong chart. Yeah, it went up a little bit today, it looks like.
okay, is a good idea. Watching only. When do you think there'll be more inventory in the housing market? I would like to think, Linda, that, at least in California, like the trends that I follow, as much as it's been a different type of market with COVID and you don't see the normal seasonality, like it was a super busy winter when usually winters are slower. There still is seasonality trends in real estate where the summer was hotter than the winter, even though they both felt really hot. And so I feel like, and maybe it's wishful thinking, that the spring will bring more inventory. We hope as, the everybody hopes to have things open up and the economy recover and vaccines out, that's going to allow some people to feel more comfortable about letting people in their
Yeah.
house and showing their house and selling their house. And so hopefully this spring there's going to be more inventory. The real question, the $1 million question is, if rates go up a little bit and that quells the demand side, and if, more houses come on the market and that, adds some inventory to help the supply side, how much help is that? Because right now there's such an imbalance that if we went in my market from 0.5 to 0.8, to 2 months of inventory, it's going to help, but there's still going to be 3 to 5 offers on every house. It's still going to be competitive. It's still going to be, leaning towards a seller's market. But a long-winded way to say, let's hope this spring.
Yeah, I'm completely with you. My Mike's going back to GameStop. He said it's up 18.34%.
Oh,
Look,
good.
I'm holding on until we're up to I want 18,000% is what I'm waiting for. So
Well, if you bought early
18
enough, you'd have 18,000%.
8 yeah, I didn't buy that early.
Al asked a good question. Is there a difference between hazard and homeowners insurance? When you hear hazard insurance, that means homeowners insurance.
Yeah.
Same stuff. It's to protect you against a hazard like your house burning down. And if you're in California, a lot of parts of California, due to all those fires and stuff, homeowners insurance has gone through the roof.
Oh, I imagine.
There's some areas, Kyle, that like, more rural, like an hour from me, where it might have been $1,500 a year for homeowners insurance, and now it's like 6,000.
Wow. It's very similar to yeah, around here, there's not, you may have a tornado that comes through every once in a while, but no crazy natural disaster. So like homeowners insurance around here, you're looking, yeah, $1,500 a year. We're like, we do loans in Florida too. So, homeowners insurance for the same home is like 6 grand.
Wow.
So it's interesting to see those differences, like you mentioned, is huge depending on what's going on.
Yep. up
There's
18%.
not a they didn't do anything shady like make a separate like a wildfire policy because if or rider or something like that because I feel like
California
insurance.
Fair Plan is what it is out here. So you got to have like a separate, yeah, like
What is it?
California Fair Plan.
Oh, okay.
So you have
So
your regular
shady.
hazard plus the California Fair Plan, and you got to pay for both. It makes it to where a lot of people are like, oh, I can move to this area, and the houses are 300,000 versus 450. And I would tell buyers, listen, if you're looking in this and this county, make sure you get a homeowner's insurance quote, and just tell me the address. I'll send it to agent partner of ours, and we'll get that quote. Because if the homeowner's insurance is $500 a month, that's gonna you know change the math a little bit. You could buy a house that
Yeah.
costs 100,000 more with less of a insurance policy.
Yeah.
Locked in at 275, but had to pay 1.8 points in FHA last year. My lender said I'll never have to refinance, even with the PMI. What do you think?
Oh, I don't like that answer
My
for that
spidey senses went up. I mean,
one.
I think I heard you talk about it in one of your videos, Kyle, and I'm in agreement that for the most part, the FHA loan is a short-term loan. It's not a loan that you plan to stay in for 30 years. And if I would have looked at your scenario and done a little maybe coaching, you might have been able to take a 3.25, not pay any points. And if you had any aspirations for improving credit, getting your credit to 7 or 720, we could let what happens in real estate and let the house appreciate over 3 to 5 years, have your credit score increase, and then by refinancing you to a lower rate and removing the mortgage insurance, you'd be in a lot better place. That 1.8 points you paid up front is a sunk cost that you'll never get back. And so the good news is that 2.75 with mortgage insurance is a decent looking loan. It's not like you're in a bad loan, but I just don't know if I would have paid all those points up front, knowing that an FHA loan is generally viewed as a shorter term deal.
Yeah. Yeah, it's something that I'd be super interested to see like an actual refi comparison between the two, to see if you can get a quote from Rob, if you don't mind mentioning what state you're looking in. Because if you're in California, get connected with Matt. If you're not, you can go to like certifiedmortgageadvisor.com and find somebody who can help you look at that refinance in a little bit more of a granular view. There's some calculators that certified mortgage advisors have access to on the back end that don't really exist, that you can just get online. And a scenario like that's going to require a little bit more intense math than just looking at what the rate's doing.
Right. Yeah. And followed it up with the break even mark of 6.5 years. I generally don't see people in FHA loans for that long. And so that's why, my initial thought is I'm not going to advise people, paying points on a conventional loan makes sense for some people. Sometimes paying points on an FHA loan, not as much. And so the 1.8 points seems like maybe ill-advised. I don't know. Spring will bring more inventory. Mike, this is the Diamond Hands, right? Diamond Hands, Mike.
Diamond Hands Mike. That's gonna be a good nickname now.
I'm rooting for your
I'm
game.
holding with you. I'm holding with you, Mike. Don't worry.
4 new listings in 3 weeks to 12 just this past Friday and Saturday. That's good. I really do think that we're going to see more inventory. And I mean, if home sellers have a place to go and have a plan, I mean, it's a great time to sell. So yeah, let's all hope that we see some more inventory in a normal year pre-COVID. We're about to see, James, March 1st today. So I pay attention to my market, and I'm yet to see a flood of inventory, but there's some great folks in my market that track some data, and so we'll start to see that. It would be welcomed in many areas, some more inventory.
I'm sure.
One of the best memes I saw was that Tom Brady has more Super Bowl rings than there are houses on the market.
Yeah, the inventory shortage is tough.
All right, Krayler made. If you've been self-employed for more than 5 years, me or Kyle or any lender you're working with could run our automated software, and it could tell us we just need 1 year of tax returns. So this, could be true. Just make sure that they're doing that for you and they're getting those automated findings before that they advise on it, because it's for sure you've got to show that you've been self-employed for more than 5 years to only have to use 1 year. And you just want to be, in general, when you're getting a mortgage, you want to be as thorough as possible. You want to give the mortgage lender as much information as possible. You want them to, dive in as deep as possible. And so that you're not putting in offers, putting in earnest money deposit, paying for an appraisal, paying for inspections if you don't qualify. So This is me getting really passionate about, like, make sure that the lender does their due diligence and does right by you by making sure you're, the guy probably isn't thinking about that.
Other caveat too, if I'm remembering correctly, is if you've been in the same, let me try to think of a fake job, or not fake job, like a scenario job.
So you're a hairdresser that
if you're
working a salon for 10 years and then you were self-employed for 3.
Yeah, or like if you were W-2 as like a graphic designer or something, and then you switch to being 1099, so you're self-employed, or 1099 or whatever type of business you're setting up there, then you could go 1 year self-employed, right?
I believe so. Yeah. But make sure that, like you touched on earlier, Kyle, there's certain lenders that have overlays. So you want to make sure that you've got a lender who's writing to the guidelines. And, I know certain companies that are strict, they're going to say, no, we want you 5 years self-employed. No, and then others that'll say, okay, yeah, same industry. You've been there for 13 years, even though only 3 of it self-employed. So sounds like you're doing all the right stuff, Krayler. Letting them lead and ask the questions. Just, tell them to, try to give you some sort of reassurance that they can get the loan.
Yeah, hey, I've been looking online and this thing said I need to be in business for 5 years.
Right.
Is that something that you guys do too? Like, that's an easy way to kind of help them maybe reevaluate, like, oh, do I need to check this?
Right. Yeah. I mean, because as a mortgage professional that deals with people all the time, it's usually the opposite. People are like, I don't want to provide you that. I don't want to provide you that. If you as the consumer are saying, hey, listen, I want to make sure I'm qualified and whatever you need, I'm willing to provide. That's great. Do that. And you're rarely going to get pushback, because it's generally like, yes, I need every page of the bank statement. And yes, we've got to order a verification of employment. And yes, I want to collect this stuff ultimately to serve and to protect the consumer from getting into a deal where they can't perform and can't close a loan. So you're on the right track, Krayler. No problem.
I had a lady once ask for a letter of explanation for, what was it? And I get it. Like, the hard part about the mortgage documents is, like, you might send in one document and then that triggers the underwriter to ask for 2 other documents because something came up in that one document that showed them new information. And so she was getting frustrated, and she wrote a letter of explanation for something and included all of this. Like, it was a very funny letter that she wrote. Not funny in the moment. She was very mad. But she included all this extra stuff. She put in like her blood type and everything. And so, like, but it had the information that I needed. So I sent it to the underwriter, because I certainly wasn't going to say, like, can you please take off your blood type and re-sign it. I was like, we'll just send it in. And the underwriter called me and he was like, did she mean to put her blood type on here? It's like, yeah, she's not happy.
Right.
So, but it gets closed, and it's frustrating.
Right.
But
Yeah, lending guidelines at times seem a little strict or they seem a little wonky, but just know whoever you're working with, me, Kyle, every loan officer across the United States, like, we don't make the rules. We just got to abide by them. We're submitting a package to the lender. The lender is trying to submit a full package that they're going to go and sell off in the secondary market. So they've got rules that they've got to abide by. And, I made some videos earlier this year because I had, pushback from clients. I understand that you make $500,000 a year and you've got $1.2 million in the bank. You could buy this house cash, but that still doesn't take away from the fact that, like, the guidelines for mortgages are set guidelines, and you've got to provide, homeowners insurance for every property you own. And, I had a borrower that just was like, why in the heck do you care what my homeowner's insurance is on that, third property of mine. It's not going to affect the deal. You think I'm not going to pay my mortgage? I know you're going to pay. I know you no risk to default. It's just
Yeah.
the rules are the rules, and there's something we all got to play by. So
Yeah, I think it's helpful sometimes to think about it like it's a game, like we're playing a game basically. That's kind of what it is. Like we're following the rules to win the game. We need to follow the rules, right? We need to understand what it is, uh, and so it literally is just kind of like real estate games like Monopoly. It's like if I want to win at Monopoly, I need to understand what the rules are, and so that's kind of what the whole point of like why we're doing this live, why Matt has tons of videos on mortgages and home buying and understanding the process is like when you know the rules, you're going to win the game better and better than all the other people who are trying to win too. And so when this one thing comes out of left field that I don't want, like I land on the tile that says go to jail or whatever. I haven't played Monopoly in forever. Whatever that tile is that does something bad, it's like I have to say, of course, this is part of the game, right? This is just the way it works. I can complain and be as frustrated as I want, but it's not going to impact me winning or losing. I just have to understand what the rules are, take the things as they come, roll with the punches. That way I can get to the other side. And then I don't know, does Monopoly end? Do you win? I don't.
yeah, I think everybody goes bankrupt, and it's funny because
Okay.
when you've got kids, I've got two boys that are 8 and 12, and me and my wife play probably a couple times a month Monopoly. The boys love it, and yeah, basically you land on the properties and you got to pay, and you run out of money, you go bankrupt, and so that's how the game ends. Somebody has all the properties and all the money.
Yeah, Mike said like I never made it past hour 2. Yeah.
Well, you can win Monopoly.
I I always thought the rules were like you give up at one point and whoever has the most money wins.
I think after a couple really long games with my kiddos, either my wife or I, one of the two of us, looked up. There's like a short version, and you can basically say like, instead of this, everybody gets 2 properties to start, and you get this much money instead of starting with more money and having to get all the properties. So,
Man, I should
yeah.
have been playing that one.
You know what I just bought for Christmas for my kiddos is what's the game? It's like a souped up Monopoly.
Cash Flow 2.
I haven't played it yet, but I bought Cash Flow. That one should be fun. A couple times a month. Yep, James, a couple times a month. The kiddos love it, especially when they win. My 8-year-old does not like it when he doesn't win. He gets really upset.
Mike, yes, those are the same rules for life. This is we're switching from mortgage advice now to life advice. So
Right. Yeah. Now it's
buckle
up. Oh man. I appreciate you coming on, man. I want to respect your time. What time is it for you out there?
It is 9:07, and I'm actually good. I'm good for a little bit more. So
Okay. Cool. Yeah. I mean, we could get into all kinds of advice. I enjoy
we got
these
some
things.
good questions in here too.
Enjoy the conversation and all that. And it's really cool to watch your channel explode. I mean, I think what that's proof of, Kyle, is that like this information is beneficial to people. And the fact that like, you've got 8,500 people that subscribed in the last month shows that like people are finding the channel and realizing like there's so much value in that. And, back to like when we first started this live, I talked about like, people could watch this and get an education on mortgage that saves them tens of thousands of dollars. So, maybe instead of that Netflix show that you watch a couple hours a week of, you get a little bit of mortgage education or whatever you're into. That's why I love YouTube. I mean, I started creating content on YouTube just because YouTube was like my place of like to learn things. I would come on here and learn how to fix the fridge, learn how to fix my dryer. I fixed a dryer and a fridge. You'd be pretty impressed. The guy that's not like, very, very, I'm a numbers guy, and I'm a not a very hands-on type of guy. So the fact that I did that, impressed myself.
It makes you feel so much more like competent as a person. You're like, things that you don't know how to do, you're like, but I could do it. I can go watch a YouTube video and I can accomplish that.
Right. Yeah. You can basically learn how to do anything on YouTube. I had a contractor who was working on a fourplex I bought, and it wasn't any super complicated stuff. And maybe he wasn't a contractor. He was kind of just he was married to the property manager, and he had some experience working for a housing authority or something. And he was doing floors and he was doing paint. And I asked him about something else. I was like, you know how to do that? And he's like, oh yeah, man, I got a degree from YouTube University. And like basically he was telling me like, if I don't know how to do it, I'll look it up on YouTube. Actually, you know what? To come to think of it, I fixed a water heater a couple weeks ago in an investment property that I've got. And I told my wife, I'm like, what am I going to go look at? I don't know anything about water heaters. She's like, just go look at it. And so, to appease my wife, I'm like, okay, I'll go look at it. There was a fuse that was busted. I was like, all right, maybe I'll try to change the fuse and see if that
Yeah,
works.
yeah.
Go to Home Depot, buy a $13 fuse, and I did it.
That's amazing. Yeah, you can literally find anything on there, um, which is wild. I don't know. Do you have those people in your life though who like they're so adverse to learning things that like so for instance you fixed your water heater, right? Water heater, right?
Yeah, water heater.
Um,
Yeah.
and so you'll tell that story to somebody and then maybe they have a problem too and they're like, hey, can you like my washing machine is not working, can you like help me out? You're like, you would be looking it up on YouTube. And so
Yeah.
like, but you end up still helping. So you're like, are over there, you looked up something on YouTube and then went and fixed the problem. I was like, you could have done the same thing.
Right. Yeah. So when somebody asks you a question, you're like, I'm going to talk to my friend Google. You probably
Yeah.
have it. You probably have that friend in your Rolodex too. Like, look up the
Yeah.
question for sure. I just saw something pop up that we were talking about floating back to mortgage now. Not sure if you talked about the floating rate question before, but what is the typical buyer who would choose a floating or variable rate? Two different things, James. And the we're talking about the float down, I think, right, Kyle? Is that what this is alluding to?
Yeah. So there are kind of two questions in here. So when you're talking about, let's talk about floating first. There's floating versus locked, and then there's fixed versus variable. And they're talking about two kind of separate things, but they're both talking about the rate. So it's a little confusing. One is happening before the loan closes, and the other one's happening after the loan closes. So when we're talking about floating versus locked, that's before the loan closes. So maybe we're going to close our loan in a month, and our interest rate right now, do we want it to fluctuate with the market? And if so, it's floating with the market, kind of like a wave. Or do we want to keep it in place? We want to lock it so that it stays the exact same at closing. And then fixed versus variable is after a loan closes, is the interest rate going to change or is it going to fluctuate? So if it's fixed, it's going to stay stable, right? It's not going to move at all. If we get a 3%, close it at 3% on a fixed rate, it's never going to change. It's going to be 3% 30 years from now or 29 years from now. Variable rate is going to have a term to it so where it can actually fluctuate. So it really kind of is these two different, or I guess four different phrases to describe how the rate is going to move either before or after closing.
Yep. Summed it up nicely. I don't even need to add anything to that, except for that in an environment like we have right now where things are rather volatile, whether you're buying or you're refinancing, it's probably a good idea. If you like it, lock it. And I think that that's the advice that a lot of people are getting from me after.
Beyonce has that advice too.
Beyonce does?
Yeah, she said if you like it, put a ring on it.
Yeah. That's what I tell people, you want to put a ring on your rate right now. YouTube University is a good one.
He was asking, did we answer the question? What's the typical buyer who would choose? Maybe what's the typical buyer who would choose fixed versus maybe like an ARM, like a variable rate ARM? I don't know. Do you have some insight into that? Like what would a typical buyer, what are the buyer profiles of who would choose fixed versus who would choose an ARM?
Well, I think I've talked to some people that are like very, very certain that there's no way I'm in this house 5 years from now. This is, whether it's a refinance or a purchase, like I know in 2026, I'm off to Kentucky or whatever it is. And so, the savings they'll get from that ARM, that adjustable rate mortgage is something that they want to take advantage of because they know that they're going to have circumstances that take them, somewhere else. And so, it's got to be such a small percentage of people that are doing adjustable rates right now, just because like I touched on earlier, they're so close in an environment where the fixed rate might be 6 and an ARM might be 4.75, then you're talking about a big difference. But, when it's 2.8 versus 2.6 or 3.1 versus 2.875 or whatever those ARM versus fixed rates are, it's not enough of a spread to take on the extra risk of an ARM for a vast majority of people. But there is a small, subsection of people that say, hey, listen, a quarter is a quarter. And if I'm going to save $70 a month with that ARM, I want to do that. Either I've got an exit plan, and like you said, have an exit plan for a few years before the thing is going to adjust, or just know that
Yeah.
you're going to sell, move, or whatever.
Yeah. If you are interested in learning more about ARMs, because you are bored and have too much free time on your hands, you can Google. There's actually a PDF that's actually given to everybody who gets an ARM, that's made by a government entity called Consumer Financial Protection Bureau. And most people never read this, but there's tons of good information in here. People shorten it to CHARM, but you can Google Consumer Handbook on Adjustable Rate Mortgages. There's a free PDF. You don't have to enter any info. How many pages is this? This is like, there's tons of just really, really good.
Take out a mortgage to read mortgage disclosures. This is
I know, crazy, right?
You can
It's
read
40
mortgage disclosures.
pages.
Yeah.
But super good stuff about like how the ARM actually works. And then same thing on like the regular fixed rate side, everyone gets a PDF called Your Home Loan Toolkit, and it's super good. Like there are sometimes I base videos off of like the sections in there because they do such a good job at explaining complex information in a really simple way, and it guides you through the process pretty well. There's some things that are like, maybe there's more explanation that could be needed there, but they're trying to condense the whole buying process into a little PDF, and
I should
everyone
definitely.
gets that.
Yeah,
What?
yeah, because it's in every disclosure package, and probably page 50 through 80 or wherever that toolkit
Mhm.
is. I would say 2% of people read it, but
Yeah,
a lot of people would probably benefit from reading that. For those of you that don't like to read and just want to listen to a video, maybe I'll make a
yeah,
video going
and
over
it's
it.
nicer to have it up front too, like because most people are gonna get like it's so dumb. You get this PDF that explains like how to shop for rates and your budget, like even stuff like budgeting or beginning the home buying process, and you get that with your initial disclosures. It's like at that point, we don't have time really to be going through this workbook. This workbook should have been done like a month or started a month ago.
Yeah, I mean that's testament to finding a YouTube channel like yours, getting yourself educated before the home buying process. I, harp on people about, do as much as you can to get as prepared as you can, because the home buying process becomes that much more enjoyable when you've put in the time and you say, I know what price range I'm looking in. I know what monthly payment fits with my budget. I know what my payment's going to be with 5% down. And once you have all that stuff figured out, then you go out shopping with a real estate agent. You get to go out there and feel the emotional side of like, oh, I really like this house, and I know all the
Yeah.
financial stuff that's tied to the purchase at this price. So I don't have to worry about that. I can just go out and find the house that works for me. That's something that I think is probably missed. Like you said, some people seeing some of that information and some of that advice, that's the first time they're seeing it, and they're at initial disclosures in contract. Um,
Yeah.
I'm gonna pop
Did
this
we get
question
a
up.
question? Oh yeah, go ahead. I think there was a question earlier too about what does it mean to buy down the rate. Did we cover that?
I don't think so, but that would be a good one. We'll go there next. I
Cool.
probably missed it about buying down the rate, but do you do real estate investing via mortgages, and what is the likelihood of actually getting approved for 2+ mortgages as time goes on? It's hard enough to get one mortgage for most people.
Yeah,
I Yeah.
I can
And
take
so
this.
okay. I work
Um,
with investors, and so
yeah,
what were you
actually,
going
you
to
go
say?
for it. You might have some more experience.
Well, I mean, it's very similar in how you qualify, and it's math, right? It's on one side you've got $8,000 in income, and on the other side you've got a $1,600 mortgage plus $300 in a car payment plus $250 in student loans. And as long as the ratios work, meaning that what your debt is compared to what your income isn't above 45% or isn't above 50% or whatever programs you're using max debt to income ratio, as long as you're within that, you qualify. And so to your point, Kraler, it's more difficult when you're going to add a second property or a third or a fourth, because now you're taking mortgage A and mortgage B. The good news is that, let's say you bought a house and you lived in it for 3 years and you decided, okay, I'm going to move out. I want to buy another property, and I'm going to make the first one an investment property, you can use rental income from the house you're departing. Or if you're just staying in your house and you're buying a rental property, you can use 75% of what that thing would rent for on your income side. So now you've got 8,000 income plus 1,500 of the 2,000 that it would rent for. So you've got 9,500 on the income side to go against mortgage one, mortgage two, student loan payments, car payments. And so, yes, it's harder because it's two mortgages on the debt side, but it's certainly not impossible. What else would you say to that, Kyle?
Um, I don't think there's too much that I would add to it. I mean, other than like you're able to use some of that rental income to help
Yeah.
offset that. So that's, for the most part, you probably shouldn't be running into too much of an issue as long as you're not like, as long as your first home purchase wasn't you on the edge of qualifying, you're probably gonna have a good chance of being okay as you go on with some of those investment properties too. And if you do have some issues with that, there are programs that like don't even look at your personal income. They just underwrite they underwrite the cash flow of the property. And so those are also great options. Your rates can be higher, sure,
Right.
but
Yeah.
you didn't
And
have
I
to.
mean, like I see with a lot of different mortgage guidelines, if the mortgage guidelines restrict you from buying something, it might be, to protect you. If you're going to over leverage yourself and you're trying to, get yourself in a position where you've got $4,700 in mortgage payments and you're only making $7,500 a month, that can be a really, a recipe for disaster. And so sometimes people get frustrated with like, oh, I wish I qualified for more, or I wish I could, do a little bit more. Well, in everybody's perfect world where things are always going up and, you're always working full time and stuff, it can be great. But if things go wrong, you don't necessarily
Yeah,
want to be, leveraged to the till.
yeah, yeah.
All right. Oh, we're going to go back to how rates work. I don't know where it was, but you saw something about
I think
like
it was just
buying down the rate.
like a couple comments above Krailers. It was, I don't know how to say the username. Amy Amy Ann 2814. What
Boom.
does it mean to buy down the rate?
You go on that one.
Um, Basically buying down the rate is you're kind of think of it like paying prepaid interest. You're paying it up front to get a lower rate. And so similar to golf, interest rates are given at a par, right? And par is kind of usually like zero, right? Because golf is confusing and weird, and I suck at it, so that's why I hate golf. So
Know
interest
anything about
rates.
par because I'm not nowhere near it.
um, so every rate has a cost associated with it. Okay, so let's say our fake rate is going to be 3%. All right, I'm trying to get it so it's not over my face. Let's say our interest rate is 3%, and that cost is $0. Okay, so for us to get a 3% interest rate, we don't have to pay anything for it. Now, what if we wanted to actually lower our rate? And I'm going to make up fake numbers, so these are not going to apply for anyone's situation, just for demonstration purposes. 3% rate, maybe we want to take that down to 2.875%, okay? Because we know that's going to save us X amount of dollars over the life of the loan. So to get that rate, we can actually pay money for it. And maybe this costs us 1 point, and 1 point would be 1% of the loan amount. So let's say it's a $300,000 loan. We paid $3,000 to lower the rate. Okay, and these numbers, this math is not going to make sense on your loan. Again, I'm just pulling numbers out of the air here. We can do the reverse as well. So 3%, well, maybe we want to take a 3.25% and we need some money for our closing costs. So then we can get a credit of 1 point. All right. And so when people ask like, what's your rate? It's a confusing question because it's what rate do you want? Right? Because you can choose almost any rate. It's just what you're actually asking is what's your par rate? What's the rate that's not going to cost me any money? Because if your par rate is 3.25%, you'll be able to find a lender who can give you a 1.99, but you're going to pay a lot of money. And it's most likely not going to make sense for you to pay that kind of money for it. So you kind of have this trade-off of what rate are you going to get versus how much are you going to pay for it or get a credit for it. So often when a lender offers a lender credit, basically what they're doing is they're increasing your rate to give you money back towards your closing costs, right? So we could actually remove the lender credit and have our rate lowered down to a par level.
Yep, that's it. Yeah, and that's the problem with, a consumer who just looks for rate, or they get, drawn by an advertisement that says 2.25%. The rate only tells you one piece of the puzzle. If that 2.25% cost you $17,000 in what Kyle called prepaid interest, I like calling it prepaid interest. I don't know where you got that, but I like it. You're paying points up
Yeah.
front,
Yeah,
and
it's not entirely accurate, but it's a good way to at least kind of
it's a really cool way to look at it. Yeah, because it's like in the future, you're going to have a 2.25 rate, and you might pay $170 less in interest per month going forward, but you pay this big $17,000 chunk up front. And something, in closing on that question to think about is that a good mortgage advisor is going to look at that whole rate sheet with you and say, listen, 3% in Kyle's example is the par rate. It costs you nothing. Let's look at 2.625. That saves you $45 a month. But if it costs you $4,500, that means 100 months to break even, and depending on how long you plan on staying in this house, other factors like today's dollars versus what dollars are worth 8 years from now, it might not be a good idea to spend all that money up front. I know plenty of people that pay points up front, and it's almost just like a vanity thing. Like, I just want to
it's
show my friends at work this low rate.
yeah, it's almost always better to take that money and put it actually to pay down your mortgage. Either put it on the down payment or put it on the first payment, or take that money and put it into an equity, like put it into an index fund or something. Don't go put it on GameStop. Put it on like an S&P index fund or something like that. Usually is going to net you a better benefit than getting that lower rate that's going to make you feel better emotionally.
Right, right. Can I get a mortgage on a house I already own, fully paid? Looking for a loan, not a HELOC or a home equity loan. The simple answer is yes. Cash out refinance and, up to 80% of what it's worth if it's your primary residence. Just, pull that cash out. Pretty common deal.
Yeah.
So it means that the neutral rate fluctuates based on credit score. But even with lower credit scores, you can pay for a lower rate.
I can take this.
Okay.
So rates can be a little confusing because it's like, well, who is making up this number? uh, so if we talk about like, okay, neutral rate, if we talk about like the base rate to begin with, and I'm going to try to like simplify, there's a lot more things going on in here than what I'm explaining, but just for the sake, we'll talk about some of the highlights, I guess, is you do have the first market rate. Like what is, just in general, what is it costing through the entire loan cycle for that loan to be originated is going to determine our base rate here. On top of that, there's going to be what are often called adjustments. And these adjustments are made based on how risky the loan is. So for example, let's say our base rate is here, and maybe we have a 620 credit score. Well, 620 isn't terrible, but it's not golden. And so maybe we have an adjustment on our rate. So our rate goes from base to increases because of that risk added inside the loan. Maybe we're only putting 3% down. Well, that's another adjustment that's getting added to our rate. So it has to come up. So we first have our market rate, depending on what's actually being traded in the bond market. On top of that is risk profiling that's being added into the rate as well. And then, like you mentioned, yeah, if you have a lower credit score, you can pay for a lower rate if you'd like to. I would recommend it. And if you're considering that strategy, what I would first look at is, okay, if you have $5,000 that you were going to pay for lowering your rate or whatever you're going to spend that on, maybe we take $5,000 and come up with a strategy with a company like My Credit Guy or a really helpful credit coach, take the $5,000, see how we can pay down debt in a way that's going to increase our credit score so we can get the lower rate that way. That's going to save us way, way more money than just trying to purchase the rate down while still having our credit not be in the place where it would benefit us if it was higher.
Right. Right. Yeah. It's a really common topic. I've got videos. I wonder if I could share this real quick. That's not the screen I want to share. Is that the one? Hopefully I don't mess this up. Is it which screen is it sharing? Is it sharing this one with the rate sheet?
Yes, it is.
Okay.
You might need to zoom in quite a bit though,
This is
whenever you get down to it.
nobody's specific scenario. This is for illustration purposes only. All that stuff that Kyle said earlier. You know what? How the heck do I zoom? Well, you know, just for people that really like to see an example, like we talked about, you can get 1.99 on a 30-year fixed, cost you 21,000 up front, or you can get 3%. Pretty close to par, 3.039. So, I'm not going to try to figure out how to zoom. I know how to zoom an Excel spreadsheet, but not that. So, that's enough. Krayler, we appreciate you. I saw the what is this thing called when they do the super chat? Is that super chat? I'm new to all this stuff. Thank you, Krayler. Much appreciated. I think it was funny. Chelsea's follow-up comment on this was sorry for all the caps. Trust me, I'm not offended. If you've been originating mortgages for any period of time, you have very thick skin. You cannot be offended. You got to have thick skin, and you got to not be offended easily working in mortgage, because people, when they're going through a process that's stressful, sometimes they tend to take it out on you. So I've
What? No, never.
developed some thick skin, but I'm not the one making the rules. I'm just trying to help you get to the finish line. So would you recommend locking into the current rates? And here's the issue, Chelsea, and I talked about this in another podcast that I was on about your specific scenario. Like, you're closing in June, so you've got a brand new build, and depending on the lender you're working with, it's either a long lock or it's a lock that's not available. Some people's builds aren't done until October, November 2022. And this is something that I literally thought about these people when I saw big uptick in rates, from February 11th through the 28th, or whenever we saw, that period of uptick. And so you want to contact whoever you're using for that loan, Chelsea, and probably April, May, June. If you're 90 days out, then you can look at a 90-day lock. I talked to someone earlier today who actually had a builder's lender who had a 180-day lock. And it was interesting because they paid 50 basis points, so like a half a point in cost for this 180-day lock. They got one float down during the 180 days. And then there was some caveat where they could get that refund of that upfront cost. But whatever it is, I think it benefits you to have the conversations to kind of know what your options are. That's my best advice, because all lenders are going to be different. All of them are going to be priced different. In general, if we look at a 30-day lock, a 60-day lock, a 90-day lock, the 90-day lock is going to be more expensive. So maybe the 90-day, your rate is 3.375, and the 60-day, you're 3.25, and the 30-day, you're 3.125. It doesn't exactly work like that. It's more like what cost you pay for each specific rate. But for general purposes, maybe it's something like that. Then, you've got the certainty where if you lock on 90 days, like, okay, I'm locked and I'm set and I'm going to forget it. But, if the market stays flat or it gets a little bit better, and the 30-day lock, 30 days out is much better, then you might be in a worse position. So it's hard for me to give advice because there's so many different variables. What kind of advice would you give somebody, Kyle, in that scenario?
Yeah, I'm fully with you. It's hard, and the locking recommendation is really difficult too. I'm not sure where I feel like it'd be more of a conversation with an attorney. I'm always afraid to give like general locking advice
Yeah.
on to people who aren't clients. To people who are clients, like, we both have a license to talk with our clients about things like that. When it comes to like general locking to everybody in the nation, starts to become, I feel like, a bit of an issue. Maybe it isn't, but
Yeah.
it's telling somebody whether based on the market, you should lock today or not. It probably is not a fair conversation for me to have with anybody. Just because, if we give a recommendation on like, yeah, lock now, and then that ends up, you lose money. If if you gain money, if you benefit from it, we'll never hear about it. But if it goes the other direction, then yeah, I certainly don't want that being recorded. So it's tough. Like Matt said, the hard part is you're looking at those longer time frames. And I'm fully with Matt on like just look at what these options are. What are the costs of each of these locks? Because they are going to have, we're going to have to pay for uh, the rate to stay the same over a longer period of time. That's riskier for the lender. So we need to have that cost in there. So we need to see what the costs are. Um, and then too, like it's important to keep in mind that over 90 days, can rates change a good amount? Sure. But it's not something that I would spend so much of my time and energy on. Uh, where I'm trying to like nickel and dime my mortgage to death. There are bigger moves that we can do to add certainty of what kind of return we can get about our mortgage than just when do I lock my rate. Um, and so I more try to stick on, can we spend energy on those conversations of like where can I guarantee I'm going to save money on my mortgage? Things like what am I doing with my overall debt strategy? How is this mortgage being structured? That I can guarantee my return versus the lock is, I can put all the data together in the world to say I have so much certainty about this decision on locking, and a new pandemic comes across and derails everything in there. Like, so unfortunately, there just isn't a good answer. And
Right.
so, like Matt said, I think it comes down to let's look at the costs and then let's kind of go with what, based on the research that we've done, what feels like it's going to be the right decision. Because unfortunately, we can pull data together all day long, and it's going to come down to what does our intuition say about where is the data pointing? And for us, it's going to look different than for other people.
Yep. Best of luck to you, Chelsea. It's a, interesting spot to be in right now, but make sure you know all your options. I think that's the number one thing, and best of luck to you. Linda, I want to answer this one because I've had, during these times where it's a little bit harder to get an offer accepted, we've got people who are in the pre-approval process and looking for longer periods of time. So this comes up where, you've started to get real serious about your finances. You've, paid down some of your debts and you're preparing to buy a house. Your credit score goes up. The good news is, Linda, we repull a new credit report and you went from 717 to 745. We can use that new credit score. Better credit means better terms. And so, absolutely, we can use that new credit score, and it's going to improve the terms on your loan. And, so that's a common occurrence.
Yeah. Yeah. Congrats on your credit score going up.
Yeah. Good
That's
job.
not always
Good
easy
job.
to do.
Buying a new construction home and it's closing in May. Lender offered a 120-day lock for 3.5, but wants 1% up front. Holy moly. And here's the thing too, is like me and Kyle are going to give some general advice. Every lender is different, and every lender has a different cost for these different like length of locks. So it's really tough. One piece of advice that I give to all people who are buying a new build, and I've got a video on it that I've probably sent to 100 people because they've always got questions about, do I have to use the builder's lender? You absolutely don't. The builders are, at least in California, going to be really aggressive and offering huge incentives for you to use their lender. And so half of the time you're better off using their lender. And I'll tell people that because that's just how I roll. But certainly in your situation, get a couple second opinions and just compare them side by side. And if, you can find a better rate elsewhere and you can do a 90 to 120-day lock, then you might want to do that. Another thing that you can do, and it's more, new home build advice that I give people, is sometimes somebody comes to me and says, hey, listen, like this lender hasn't given me any advice, and I had to get pre-approved with them because they worked for the builder, but I want to work with you, Matt. If I can beat the builder's lender, sometimes the builder's lender will then undercut me and go even lower, which, all the better for the client, like it's, whatever the case, because, at least in California, the builder in a lot of circumstances owns the lender. And so, they've got vested interest in you using their lender because they own that company. And so,
sometimes I see too, like if people we'll say like, uh, yeah, the builder's lender is charging all these like upfront fees. Like, yeah, but the the lender might be charging maybe more fees than another lender would, but because you're using that lender, the builder is giving you like this $15,000 credit. And even though they're separate, they're kind of the same because if you switch to another lender, you probably aren't going to get the credit with the builder. And that's the unfortunate thing. And like, that's why it's good to work with somebody like Matt who's willing to tell you like, hey, this this offer, it's probably something that I can't touch.
Right.
And
Right.
it's good to work with somebody who can do that instead of trying to say like, look at all these fees they're charging you because um, from most quotes I've seen, a builder's lender, like I can't touch. For me to like be able to compete with their offers sometimes, it would mean like me and our company making $0. And unfortunately, I can't work for free. That would be a really nice luxury. But it's just because they, like you mentioned, they have a vested interest. They work together, and so they're able to provide those kinds of savings, and they have more margin. It's easier to provide a $15,000 build credit that actually costs a lot less money than a $15,000 actual cash credit coming from a lender.
Yeah. And one hot tip that I think might be worth the price of admission for somebody like you is buying a new build. If the builders are offering a huge incentive, $10,000 incentive, and the rate's 3.5, you're like, oh, it's kind of high. Take the incentive, take the slightly higher rate. If in 6 months from now you can get a 2.75, refinance the deal, and talk to a local mortgage broker who can give you a 2.75, and that way you kind of get the best of both worlds. You got the big incentive from the builder, and then you got into the lower mortgage rate later. And the refinance like scenarios for me are always the same exact thing. It's just a math equation. We're going to save you this much money per month, this much money per year. There's this much in costs. How long's the break even? If we can break even within 2 years, you plan to stay there long term, that's a refinance that makes sense. So that might be one way you go. Same question as Chelsea. Did I miss Chelsea's?
Oh, they followed up and said it's not the builder's lender. Oh, interesting. So yeah, let's definitely shop that around then. If it's 3.5 for 1%, you know, um, conventional loans right now are averaging in the low 3% without that 1% upfront cost. So,
Right.
and obviously it's going to depend on credit score and everything. So maybe let's explore that a little bit. And you mentioned the float down. This could be one of those scenarios where like, yeah, we get a float down, but the rate was kind of padded already. So if it's not the builder's lender and you're not receiving any other credit with it, then yeah, let's definitely shop
That
that around.
seems high. Yeah. I'm gonna let you take this one, Kyle, because I think you were talking about structuring the loan, and Chelsea wants to know. She's doing 5% down, 30-year fixed. Closing costs are high. Maybe dig into what you're talking about, like structuring the
Sure.
loan.
You said we're just doing 5% down, 30-year fixed, but closing costs are high. Um, yeah. So when we talk about like structuring the loan, we're basically just kind of taking an overall look of a buyer's finances. So, what kind of assets do they have? How much money do they have in the bank? How much debt do they have? What kind of payments are being made on that debt? And then also taking a look at the mortgage. Is there something that we can do with the mortgage that would benefit the buyer? Um, you know, Normally it's a little bit easier when a buyer has more money that we can evaluate in that conversation. When we're just looking at maybe a 5% down, if that's the maximum down payment, then it can get a little bit more difficult to look at structuring the loan from a debt consolidation perspective, where we're taking some of the down payment instead of putting it on the home, we use it to pay off debt. So that would probably be out of the question in a scenario like this. Maybe we could look at doing 3% down instead of 5. But something else that you might take a look at here is maybe we look at shortening the term a little bit. Um, that could create some savings. Maybe we do 3% down and take the additional 2% and put it on the first payment. That's also going to change the total interest being paid on the loan. There's several different things that we can kind of do to explore what changes with the monthly payment, what changes with the rate, because going down to 3% might increase your rate, might increase your PMI costs that you have as well. And so um, that's kind of more what we look at on the mortgage advising side is what are the different options that we can do to explore down payments? Or maybe you have some extra cash and we can say, hey, we know you have some extra money. If you did 10% down, this would actually save you this much by changing the rate. And that's something that you could consider. Like, right, loan officer actually makes less money if you put more down. So they have no incentive for you to put more money down. They're not trying to like trick you into getting paid more. Um, but it could be something that's like, oh, we hadn't considered if we took this extra money, and even going up to a higher down payment bracket could change us lowering our mortgage insurance or lowering our interest rate, and that would create long-term savings for us. So that's kind of more in general what we're talking about by structuring the loan.
Yeah, creating a plan. I gotta say what's up to my buddy Mark. What's up, Mark, from the Mark McDonough team? I'm
Mark,
gonna have Mark on in a couple weeks. Maybe it's next week. I think next week on the 8th.
cool.
He's got a great YouTube channel all about the Sacramento market, all about all kinds of different sub markets in Sacramento. So that's gonna be a fun talk next week. Look forward to that, Mark. Do lenders read into hard inquiries? This is an interesting question, Kraler, because I actually had quite a few of these last year during the pandemic where my borrowers had inquiries from SBA, and it was never a problem. The lenders, didn't ask for, hey, what was that inquiry from the SBA 6 months ago? Because generally that's going to be, business debt that doesn't show up on your personal credit report on your personal debts. And so, they're looking at your credit score. They're looking for delinquency or, like mortgage lates and things like that. But I don't think they're reading line by line and saying, what's this SBA inquiry from July of 2020?
Normally an SBA loan would be more of a sign or indication of growth rather than struggle. Businesses normally take out debt when they're growing, not necessarily when they're struggling. But also too with that, like Matt mentioned, that's going to be something that applies to the business. It's not personal debt that you're taking on. And when, so you being self-employed, when they're actually taking a look at your income, they already have standards for how they're evaluating your business's financial health, right? Is it going to continue to keep paying your self-employed income? And one of those ways is not by exploring what types of financing you're using. They're primarily interested in what your cash flow looks like, not really any other aspect of your business.
Yeah, and those guidelines have changed. That's important topic to kind of roll through. Is if you're self-employed, be prepared for year-to-date P&L. If you haven't filed taxes for 20, you're going to have 2020's complete P&L. Last 3 months of bank statements. The P&L is going to want to be in alignment with those 3 months bank statements as far as deposits go. And so all the self-employed borrowers out there, I know it's gotten harder, but if you've got a healthy, thriving business and you're able to demonstrate that on paper, there's still loans for you out there.
Yeah.
Diamond Hands Mike is back. I just love that nickname.
You better just change the username now, Mike.
Yeah, just go Diamond Hands
here.
Mike. Yeah, it'll trust me. You can say that you heard it here first, and you can thank me later for all the accolades you get from being Diamond Hands Mike. When and if the lender pulls credit one last time, are they mostly concerned with any new accounts? Are they looking for lower credit score? My answer is going to be that it's just a soft pull. Yeah, they're just looking to see if you have any new accounts. They're definitely not re-pulling to get a new score.
Yeah,
want to make sure you don't have a new boat financed.
Yeah, unfortunately, that happens. People tend to do that.
I think you got somebody in Maryland that you can refer. Most mortgage professionals who do any amount of business are going to be familiar with, conventional FHA, VA. So, if you get a good mortgage broker, you're going to get a good, person who can find you a great VA loan. Shoot Kyle a message and he'll get you to somebody in Maryland. You got somebody in Maryland. Yeah.
Yeah. McKay Mortgage is really good.
Brendan McKay. You are. Yep.
Yeah. Yeah. They're fantastic. If you should be able to just like Google them and they come up.
Yeah. I think I've got a Google Drive with his information on it.
Yep. Yeah. If you Google McKay, MCKAY Mortgage, their homepage is going to come up, should be like first result for you. And they'd be a fantastic company to help you out. Yeah. And like Matt mentioned, most companies are going to be familiar with VA.
Right. Yeah. His company for sure. And if you're at the mortgage conference in September in Vegas, Brennan, you can buy me a steak for that lovely referral. Mike's got jokes. I mean, it shouldn't have finances PS5
Wait,
through
what's
Fingerhut.
Fingerhut?
It must be some online like
Would I know
financing
what that
thing or
is?
something.
Mike, what's Fingerhut? Should I
Yeah.
invest in it? Let me see here. Fingerhut. I hate the name. Oh, get the credit you deserve.
You
They're
finance stuff.
financing blenders?
Well, they're financing PS5s and blenders. Thanks for being on, Mail Cole. We appreciate you too.
And like bath towels?
If you're financing bath towels, I wouldn't recommend shopping for a new house. Probably.
It looks like maybe they're kind of like, it seems like some of their angle is to build credit.
Okay.
Yeah, I feel like it's just a little bit of a slippery slope if we're financing. Yeah, if I need to finance the towels, then we might need to have a different budgeting conversation.
It'd be a funny like parody like video is like you might not be ready to buy a house if, and then it could be like you're financing bath
Yeah,
towels.
because these are like 10, this is 10.99 a month for the Spirit Linen Home Spa collection, bath towel collection. And I can get my towel in the color hummus.
Oh, nice. And then how many months you got to finance that? Is it a 12-month deal?
Let's see. Total cost is $100. Okay, this is a different one. Total cost is $79.99. It's $12 a month, and it's don't they have to legally disclose what? Show me what are my financing terms? I see an asterisk, and there's an oh wait.
For the person who was looking for the Maryland broker, I put Brendan's info in the chat. Phone number, email, NMLS number.
Full cost of ownership.
It doesn't tell you like the rate or what.
Ooh, I mean, we're pushing a 25, 30% APR.
You are financing bath towels at 25%. You are doing it wrong. I think that
chart. Yeah, this is not good. And some of this shipping. Oh wait, okay, no, that's different. Some of the shipping goes up to $300. Good Lord, what is? Oh, maybe that's for like bigger products. I don't know. I'm gonna get lost in this Fingerhut world.
Yeah. Somebody check in with Kyle tomorrow and make sure that he doesn't have like a blender and bath towels on order at Fingerhut.
Look, if they'll accept my Kohl's cash, then I'm in. I'm gonna be loaded with so many new things.
So much nice stuff.
As
All right,
long as I can afford the payment.
Right. Yeah. $10.99 a month. You're good, man. This is nice hummus towels. You have an auto lease ending in 6 months. Underwriters accept prepayment of the lease. This is something that we run into a lot. And the problem with it is underwriter is always going to assume that no matter what you're doing, you're paying it off, you're turning it in, you still need a vehicle. And so when you have a car that's purchased and you've got 10 or less payments, we can exclude that payment because it's going to be paid off. With a lease, they're not as flexible. And as much as I've kind of pulled myself out of the minutia and the guideline stuff, I'm pretty sure that I'm right with this, Kyle, that you're not going to be able to exclude the lease payment, right?
Correct. Yep. Yeah, you're not going to be able to get that. Even if you're going to go buy a car in cash, they're not going to accept it. They're going to assume if you finance a vehicle, you're going to need to continue financing a vehicle.
Is the NMLS the same as his license number? Yeah. Oh, he's probably got, oh yeah, there's phone number and then NMLS. NMLS might be for his mortgage company. And then he might have a separate license number. I'm sure if you looked online, Lauren, he's got all that stuff somewhere online.
I am going to. Ooh. I'm loading up my house right now with
with stuff from Finger Hut.
mm-hmm.
You know what you should do, Diamond Hands Mike, is you should go get some Finger Hut stock. Once Kyle starts, putting in the orders, this stock is going. You know what you
Dude,
should do? You should get on Reddit and you should pump this thing. I think Finger Hut
this
could go
is
to the moon.
crazy.
It's gonna be the
This is
next big thing.
this is like a crochet kit. It's $19, but you can finance it for $9.99 a month.
I mean, this ties in nicely to mortgage and financing and responsibility with credit. Like this is the kind of stuff that gets people in trouble. I made a video recently where I talked about, encouraging people to be responsible. And when your credit is not, great, or you can't afford something necessarily, you don't want to go and buy it. I use the example of like a down payment assistance home loan where you might not get the best terms. And in the long term, it's a really bad deal. It's kind of
Yeah,
like buying a Camaro when you've got a 560 credit score and you pay 25% interest and the payment is 760. Like, congratulations to the guy who bought the Camaro is not in order because it's, just putting you that much farther behind for this 6 years of $760 payments. So,
yeah,
um, the
yeah.
mortgage guys are like, come on, use your HELOC to finance your bath towels and save interest. Exactly. I can get you cash out refinance. Forget making payments. Buy all this stuff cash.
This is not, yeah, this is not good. We probably shouldn't be financing these things. Um, it's, I hate that they are in business because you know that like people are buying stuff and putting it on payments and just getting destroyed on their interest. Um,
Right. I don't know
yeah,
how the rent-a-center stuff stays open. When you're paying like 1/4 of what something costs every month to rent it for 6 months, and like you've paid for it one and a half
right.
times, then you're supposed to return it.
Yeah,
That's not good deal for anybody. And that ties into nicely to if you can afford to buy and you're going to stay in a place for a long period of time, probably should be buying a house versus renting.
yeah.
I'm just tying it all back to mortgage and housing. Kids were financing all sorts of things from shoes to NES. Back in the day, how long has Finger Hut operated?
Have they been around for a while?
I
I've
don't know.
never
Me
heard
and
of
me and
Finger
Kyle
Hut.
just got turned on to them today. So
Finger Hut sounds like one of those mall kiosks that like I don't know what they would sell, but they sound like one of those weird mall kiosks where you have that guy who's like aggressively like talking to you and you're like, no, no, and I'm good. No, thank you.
yeah, I don't need any cream on my hands. I know it's
Yeah.
probably the best hand cream ever created.
Yeah, this is Finger Hut. Come on.
What do you think about refinancing through FHA Streamline? I know my answer, and I'm to the point where I'm just super straightforward with people. So Kyle, give them a nice answer before I say something that's not so nice.
Oh, in my mind, an FHA is a short-term loan. I try to think of it like a bridge. Our better option is going to be what do we need to do to go conventional? Let's save our money, use that to do whatever we need to do to our credit to get to the point so that we can refinance into a conventional loan. We're going to save much more money most of the time.
Right. Yeah. I mean, you're going to load up your current loan, and you're going to add $10,000, $11,000 onto that principal balance to save, in most cases, not a very significant amount per month. So a better long-term strategy is preparing to get into conventional loan. There's still scenarios where, you got an FHA at 4.25 and you can get a 2.5% on a streamline. And, it's honestly one of those things where, you have a credit issue that you don't expect to resolve in the next 2 or 3 years. So you don't expect to see the 700s in credit. Maybe it makes sense. And, I won't pound on them too bad because I've done a few in the scenarios where it makes sense, but, it's not always the answer. It's a really easy loan for lenders to do. And so especially a big online lender, call center, non-advisor type mortgage person is going to, quote unquote, sell you on it in scenarios where it doesn't
Yeah.
make sense. But if you talk to a quality broker who's going to give you good advice, then, they might give you a different game plan, a conventional loan, or something else.
Yeah. There's a mortgage company right down the road, uh, that way. I think I'm kind of directionally challenged. Um, where all they do is they send out those mailers that you get that they try to look as close to official as they
Hmm.
can without legally crossing and using like HUD's logo. So they're going to look superficial and be like, you can save X amount. And their whole business model is sending out official looking mailers to people that say you can save this much, you qualify for this special program and whatever. No, we won't pull your, we don't have to do an appraisal and income and whatever. And that's how they get people kind of just funneling through the system is they try to look official and they say you don't have to do all the stuff. And then people end up doing a streamline like that instead of looking at the total picture,
Right.
like we were talking about. This is one of those things, which is we're going back to the idea of like, how are we structuring the loan? The conversation should have happened in the very beginning when we got the FHA loan of, hey, it's great that we're getting this house, but let's also have a game plan to get out of this loan within the next 3 to 5 years if it's going to take us that long.
Right. Yeah. And that's a good spot for a public service announcement. If you get a mailer in the mail that you think is like, oh, this is specially for me, it has nothing to do with your credit score. It has nothing to do with your loan to value. It has nothing to do with anything. It is just some sort of teaser offer to get you to pick up the phone and call them. So don't fall for that stuff. Talk to somebody who's an advisor versus, mass mailer type stuff is just trying to get you to pick up the phone and flashy rate, flashy terms. They use all types of stuff. They're going to use your current mortgage company's name and say it's in regards to this mortgage with this company, and they have no affiliation at all. They've got fine print. I get them at my house too, so I know exactly what you guys are getting in the mail, and it's not good stuff.
Mike said Fingerhut was created in 1948.
No.
Is that real? Are you just trying to get us to buy the stock? He wants us to buy the stock.
I remember in the 90s. How old are you, Kyle?
I am 24.
Oh my gosh, you are just a baby.
Yeah, I was born in 96, so I don't really remember the 90s. I mean, I was there, but I have no clue what was going on.
I was a sophomore in high school when you were born. I was born in 1980.
Really? How old are you?
40.
What?
Yeah, I know. I should sell like anti-aging cream or something, right? I just
40.
Yeah, mortgage is so stress-free. It's such an easy life that I just stay young.
Dude, I thought you were like 27.
See, that's why we're buddies, man.
No way you're 40.
Yeah. I've got a kid who's half your age. I got a 12-year-old.
Well, here, I'll go mortgage lender on you. I need a birth certificate. I need a driver's license. I need past 12 months of utility payments. And then I'll
40 years old last August. Yep.
That's crazy, man.
Oh, Linda said I look younger too. Awesome. Thank you guys. You guys are just trying to get a better rate. You're trying to make me give some sort of price exception or something. I know when the compliments are coming.
The next video on how to shop for a
right. Can you waive that one fee, Matt? Because
just compliment your lender. Yeah.
Don't look a day over 27.
Mike said a dude named William Fingerhut. This is so. That's no way. That's
if we ever do something in the future, this Fingerhut saga will continue.
No way. There's no way that his name was okay. Is there a Wikipedia or something on this? No, he's right. It was founded in 1948 by William Fingerhut and his.
Have they always done like financing
selling
of
automobile
seat goods?
Covers?
Been missing out on this.
Wild.
I wonder if you could gift something to somebody through this. I'm going to send you
make the payments on it. I got you these decorative towels.
Bed and bath. Oh, Rachel Ray cookware. Now you got me looking at the dang thing. I'm going to answer this question about Bitcoin being accepted. Most lenders, last time I checked, Vol, are fine with it once you convert it to US dollars. So if you've got 2 Bitcoin sitting in Coinbase or sitting in whatever account you've got it, and you transfer that to your Wells Fargo account, we can use it. You have to source it and show us where it came from. We can't have you go into contract and have it sitting in Bitcoin. It's got to be transferred into US dollars. But, you know, like if somebody deposited $40,000 in the bank, we couldn't use that. It's not non-sourced money. You know, you got it from the cartels, wherever you got it. And, you know, so Bitcoin being transferred into an account, you could use it to the best of my knowledge. I haven't really had, I mean, I remember in 2018 when it was, you know, its last bull run, I guess. And I had a lot of questions on
I remember uh, when Bitcoin was first kind of hitting news headlines. Well, I guess that was before that, but yeah, like kind of it keeps making waves of
Right.
news. Like what, a year, 2 years ago, and everyone was talking about with like continuing education was like Bitcoin is the future, and like
Right.
more in a sense of like they were trying to like scare all these 50-year-old people in mortgages, like, you know, who are loan originators. I remember being at like a conference, and everyone I worked with was like, I'm just so scared of Bitcoin. I don't know how it works. I was like, it'll be okay. You'll be all right.
Right.
And the frustrating thing too is like, you know, with stocks, for instance, you can actually use your stocks while they're illiquid as reserves, on a conventional loan at least. But mortgage guidelines have not caught up to the world of cryptocurrency to the point where I haven't heard any talk about like Fannie or Freddie catching up with what's going on with cryptocurrency. Um, they might be trying to work on some bigger issues at this point.
Mm-hmm.
Yeah, Angelica's coming in with that cartel money.
Oh, sweet. You want to take this one about housing allotment from a military paycheck?
My monthly military paycheck shows the housing allotment I receive at my current location. New PCS locations. Housing allotment is less than my current situation. Was there a follow-up
Yeah, how would
about
an
this there?
underwriter look at that?
The underwriter is going to go based off of what your new housing allotment is, especially if it's decreasing.
Right. Yeah, I've got people that are moving to California and it's like always increasing. And so we've got to get some proof of like what the new allotment is because they're coming
Yeah.
from somewhere else that's less expensive than that. So yeah, make sure that you are straightforward with your lender and know the new allotment so that they're, you know, not catching that halfway through your loan and then saying, oh, based on your new allotment, you don't qualify. And that would be
Yeah.
a bad outcome.
And usually, trying to remember correctly, usually the allotment is quite a smaller percentage than, you know, it's only a percentage of the income. I would imagine it shouldn't change your qualifying too much unless you're like very close on the line. The nice thing about VA is you're, I mean, it's hard to say you're qualifying under debt to income because you're using residual income, which is crazy flexible compared to the normal debt to income rules. I've done VA loans up in like 60% DTI range, which
Yeah.
is nuts. Um, but I mean, they had income in other places, but we just didn't put it on the loan.
Krahler made my short answer to this is basically lenders are looking at what lands on your tax return. So, you know, if you get it through PayPal, if you get it through AdSense, if you get it through wherever you get it through, you know, it's self-employed income that's going to hit your Schedule C, or if you have an S corp or whatever, it's going to, you know, hit whatever form of the tax return it does. That's the number underwriters are using. And so there's tons of folks that have their businesses structured a million different ways. And it's like, hey, listen, I've got 19,000 a month that goes into this bank account. It really doesn't mean anything to the underwriter. They just want to see what lands on the tax return.
Yeah, and also with like sourcing payments, I'm not sure if you're talking about like sourcing like money that's coming into your account. In an ideal world, like your business bank account and your personal account should be separate. And so I'm not sure if you're talking about like sourcing, what you exactly mean by sourcing the payments, or why you're necessarily referencing that, like if it's a large deposit or something like that. If it is a large deposit, then as long as you have, it's affiliate income, you have some sort of receipt or an invoice showing that payment coming in, then that's going to be an acceptable source inside your bank statements coming in as well.
Yeah, I defaulted to like qualifying, but yeah, if it's for
Yeah.
sourcing for like a
Now, do you know, this has always been a weird one. This is more of like a hypothetical question that really isn't super important. But okay, so let's say that we get affiliate income coming in and we don't report it on taxes. Okay? So the lender can't use it to qualify us monthly as income. So we didn't report our income on taxes, so the lender can't use it. But we can still qualify with our additional, maybe of W-2 income. Could we use those funds as the down payment?
My guess is that you could, and it would just be like an LOE saying, listen, this is income from this source. It would be funny, right? Because there's plenty of circumstances where it's like, somebody makes 100 on a W-2 and they make 26 on self-employed income. And like, we don't need that. So let's just keep it out. Just keep the file clean. And if we're not using that income that's self-employed, but we want to use some of that money as down payment, I think you could. I'm not 100% sure, but I've got.
That's what I was thinking too. And I was thinking too, you could also argue that like, well, I didn't report taxes last year on the business because it didn't make as much. And, now we obviously can't show taxes looking forward. So we should be able to use a large deposit like that. I just feel like it'd be really tricky if you weren't showing the business income, but you're still trying to use business assets.
Right. I've got that written down. What was I going to ask Home Point? I was going to ask about the like offer letter. Work offer letter.
Yes.
I'm just learning so much about Finger Hut on this call.
Yeah, it's always been one of those questions I've thought in my mind of like, how would somebody look at that? I guess it would kind of be a non-issue. Unfortunately, that's what I think about at night. Would
Yeah.
this situation work?
Don't send 1099s. So,
Oh,
so
man.
like what we're trying to get clear on, Krayler, is are you worried about sourcing the funds for a down payment, or are you worried about like using this income to qualify? Because those are different things. And if it's for qualifying, like I kind of talked about the first go around, the lender just wants to see what hits the tax return.
Mhm. And if it's not enough income that they're not sending a 1099, then it's probably not a ton of income for qualifying because if I remember correctly, it's $600 or more to send a 1099 required, right?
Yeah, but I think he's saying too, like they're not sending it, which I think I've seen before, where it's just like there's no 1099, but as long as you're claiming it, which it looks like I reported all of my taxes, I've got the PayPal statements to vouch for it. Then that's the important part, is that you're claiming it.
Oh, okay. I misunderstood. I see what he's saying now. He said 1099 for significant revenue. I thought it said insignificant. Okay. I'm getting it.
So yeah, I think you're good, Krayler. Like we talked about with self-employed income, the guidelines have gotten a little bit stricter, and so you're gonna probably have to show a few months of those bank statements. You're gonna have to show your profit and loss, and then you're gonna have to show the last couple of years tax returns, and it's all got to kind of show that the business is stable and continuing to make money. But as long as you've got all those ducks in a row, you should be fine. And remember, when you're self-employed, it's not how much money your business necessarily brought in, it's how much hit the bottom line. And there's a couple of different things we can add back, but a lot of people get that confused. We're like, oh yeah, I sold 16 houses, I made 150 grand. Well, if you wrote off 95 of that, then you didn't make 150, you made 55. And that's, going to be different for qualifying.
Absolutely. Well, man, it hit 10 over here.
So I know.
It's about my time.
Like, I'm good. I'm like, I'll go all night, man. It's only 7:15 in I appreciate your time. I'm going to answer one more question just because I saw it come up.
Go for it.
Gilbert, some good advice. I can get a better interest rate if I use a grant. Is this normal? If it sounds too good to be true, it probably is. And I have not met a down payment assistance or grant program that I necessarily like. The Obama program when the housing market was struggling was meant to stimulate, and here's $8,000 in truly free money if you buy a house. Since then, there's been many different state specific down payment assistance programs, grants and whatnot. And from my research, they all come with some sort of strings attached, a higher rate, higher fees, and to be complete,
Limits on refinancing.
on the purchase side, I've just had so many people where it's like you get a second and a third loan that are tacked onto the back, and so many of those people couldn't refinance in 2020. So yeah, it's something to be very weary of.
Yeah.
We'll leave it
Mike
at
said too good to be true, just like Finger Hut.
yeah.
Yeah.
We should probably end it on that. A good finger hut quote. Kyle, I appreciate the heck out of you, man. I only asked for an hour of your time. You gave me 2 hours and 15 minutes. I appreciate it, and I had
Oh yeah, thanks for having me.
awesome time chatting with you, dude. We'll have to catch up, and we'll have to do some follow up on Finger Hut and see how you're doing with.
I don't know that I want to be a part of the Finger Hut conversation. But man, I appreciate you having me. And for everyone watching too, Matt works in California. So if he's not going to plug himself, I'll plug him for himself. So clearly you can tell that Matt's somebody who cares about people going through the process in a way that's actually going to save them money, not just something that's going to increase revenue for his business. So if you are looking for like a mortgage advisor who's going to help you through the process, be gentle and caring, and help you get a really good deal on a mortgage and structure it properly, Matt's going to be the guy to reach out to. So
Cool.
thank you for having me. I really appreciate it.
Yeah, I'll plug your Win the House You Love because it's an awesome channel, dude, full of amazing content. And it's one of those things where, on YouTube, the stuff that's good is going to get pushed out more. Kyle's got 2.5 million views. 2.5 million times people have looked and said, "Oh, this might be something worth watching." So, that says something, man. Continue to
I appreciate it. Yeah.
content and help people out, because I think that the proof is in the pudding. People are finding value in it. And I'm sure you're getting some of the same feedback I'm getting. Thank you so much. People that are in markets that we don't even serve, that we can help, on the home buying journey, that,
Yeah.
should be, scary, intimidating. It should be fun and exciting. So let's keep trucking.
Awesome. Well, thank you, man. I appreciate it.
Cool, man.